City, I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief. Let's get to the three things that you need to know today, starting with the markets.
Well, futures lower this morning as jobless claims coming in slightly higher than expected, and investors keeping a close eye on escalating tensions in the Middle East. On the labor front, more people than expected filing for unemployment benefits last week, but the 4-week moving average ticking lower. This coming ahead of tomorrow's big jobs report, where investors will be looking for any signs of further cooling.
And the rally in China stocks taking a little bit of a breather today. The Hang Seng ending the day lower after a stimulus-fueled rally pushed the index up 25% over the last month. In a new note, JP Morgan is warning investors about the risks of chasing the rally given the demanding valuations. The analysts suggest exploring opportunities in lagging China sectors like property management.
OpenAI's valuation soaring to $157 billion after its latest funding round, and that puts it on par with companies like AT&T, Uber, and Goldman Sachs. The $6.6 billion in new funding is one of the largest ever funding rounds for a private company, and comes nearly a year after OpenAI's board fired and then rehired CEO Sam Altman.
Fresh economic data this morning giving us the latest read into the labor market. Weekly jobless claims showing more Americans filed for unemployment benefits than anticipated, but overall the claims are consistent with a limited number of layoffs here.
The next test for the markets is tomorrow's jobs report. A weak report could potentially trigger a sell-off as investors become a bit more worried about a slowing economy. Now, despite all this, we've gotten a number of bullish calls out from the street. The latest being Goldman Sachs' Scott Rubner. He wrote in his latest note that his 6,000 target might actually be, quote, too low. So let's talk about that. And the reason why he's saying that is because of some of those seasonality trends that we've talked to so many guests about here over the last couple of weeks. But he went on to say that he's bullish for U.S. equities for the year end, starting with a rally that he expects to start right around October 28th. And he goes on to talk about seasonal tailwinds in the market, a key pillar of that call. Data going back to 1928 showing that the S&P tends to rally about 4% on average from October 27th through the year end. And then on top of that, stocks tend to advance after U.S. presidential elections as investors do rotate out of cash and into equity. So again, he sees a number of catalysts here for the market going forward. So here we are this morning. We closed yesterday right above 5,700. Belsky was also out with Brian Belsky over at BMO Capital Markets was out with a call just a couple of weeks ago. He raised his year-end target right above 6,000. So again, many people on the street at least finding reason to stay optimistic despite those ongoing worries about the risk of a recession.
Yeah, and one other factor that they pointed out here is buybacks rather. And the blackout window specifically that we're in right now, that blackout window extends until October 25th. Now, the largest buyer of U.S. equities in 2024 can purchase 35% less shares during the closed window. That coming from Goldman Sachs in this note and saying 6,000 might be too low. But here's what you can expect as well here, at least in the purview of GS here. They're looking for buybacks to resume in November and December and come back roaring here. That could support some of those further gains and an additional tailwind for the markets here as well, and specifically for the S&P 500 here.
All right, well, a broader rotation in the stock market boosting cyclical stocks as of late. But our next guest saying to stay long the Mag 7 trade despite some of that recent pullback. Joining us now, we want to bring in Dave Mazza. He's Roundhill Investments CEO. And Dave, it's great to talk to you again. So there's been this ongoing debate, I think, in recent weeks, whether or not the Mag 7 is the place to be, whether or not we'll likely see some profit taking here over the next several weeks or several months potentially. You've got Amazon down 6 days in a row. Why do you still see an investment opportunity here?
Yeah, no, you're absolutely right. The market's at an interesting juncture here where it was led by a narrow number of stocks in 2023. Again, at the beginning of 2024, the Magnificent Seven names, the tech leaders roared higher, and then they hit an abrupt stop in mid-July with the unwinding of the yen carry trade. And more recently, only Meta has actually hit, gone above its July high, and the rest of the names are sort of languishing. But I think it's too early to give up on these names. If you look at their net income growth, it's projected to be north of 25%. The rest of the market, the 493, sub 5%. Valuations on these names have come down. So while we don't expect them to continue to see just outsized performance, it's tough to see the market continue to grind higher without their participation. So I think a broadening is good, but actually we want these leaders to continue to be able to participate at the same time.
And for those leaders, it's really come into question how much and how aggressively we're going to continue to see some of the capital expenditures move forward, especially with AI as the theme that's benefited them, but now as one of the potential headwinds if they do overspend, even though what they will communicate to the street is that there's a far greater risk if they don't spend aggressively right now.
Yeah, so there's another challenge. So we know that the majority of the Magnificent Seven companies have actually been plowing in their capital expenditures into another company, which is Nvidia, right? So we know the AI trade has had fits and starts. More recently, it has come back, and now it's pulled back again. And it's because investors are checking themselves and saying, wait a minute, if all this money is going into generative AI, buying chips, when are we going to see a return on an investment? I think that's been pushed out to the back half of 2024, if not 2025. So for the time being, there's an arms race in AI. Jensen Huang last night was talking about how demand for Blackwell is insane because it's that much more efficient. So for now, I continue to see a race toward capital expenditures in AI. That's not necessarily going to go away, but you're absolutely right. At some point, these companies are going to need to show return on investment in a clear path. But for the time being, I think it's these leaders in this space that continue to benefit, as opposed to a name like ServiceNow or Salesforce, which is definitely exposed in spending in AI. But when they benefit is not as clear as when a Microsoft or Apple or even an Amazon can benefit.
You know, Dave, is this a call across the board when it comes to Mag 7? We obviously have seen a stronger outperformance from some of these names in particular. When you take a look, I mean, Nvidia has been under pressure here this week, but clearly that runway for growth, that has been something that investors have been closely watching here. So is this more of an Nvidia, Microsoft, Amazon maybe specific call rather than Tesla, or is this strength that you see across the board with these names?
Yeah, so it's interesting. So the name, of course, was dubbed because they were all outperforming at the same time, all had similar growth characteristics, innovation characteristics. But we have seen even in the last 18 months or 2 years that there's been times where Meta has been a laggard, or now it's a leader, and Amazon's been a laggard and a leader. To your point, Tesla is the most cyclical of the names, in my opinion. Again, at the end of the day, they're a car manufacturer, and we remain in an EV winter. Next week's a big week for that name, of course, with the robo-taxi event in Hollywood. I think that actually could be a strong catalyst for the name, because last night's deliveries weren't great, but they are really, I think, investors are having faith that Elon Musk is really righting the ship there. We got past his pay package issues. So I'm not willing to give up on Tesla necessarily just yet, but of the group, I do think there's some question marks with that name relative to the others.
Dave, just lastly while we have you, I see that Roundhill this morning has been talking about drag, and I'm not talking about drag brunches here, although great events for people who love to check it out. But anyway, one of the huge things that you're talking about is specifically the China dragons, and you've created an index, an ETF around this. Why, at a time where now we're seeing a little bit of pullback, but there is a little bit of a call on the street to look to some of the other sectors that haven't kept pace with the rise in some of the Chinese specific stocks that we've seen over the past week and change?
Yeah, so if we look at the last Bank of America Global Fund Manager Survey, the two most crowded trades were long Magnificent Seven, which I just said we still think there's some opportunities, and short Chinese equities. So it's been very contrarian. And why? They've been out of favor. They haven't done anything. They've been kind of dead weight in portfolios for a long time. This stimulus package that was announced in the last week, which has seen China stocks just skyrocket higher, is so important. That's the bazooka that was needed. We've seen that with the ECB. We've seen that with the Federal Reserve. Now we're seeing it in China. We certainly need to see more out of there. There's some demographic issues, some structural issues, but those names were so cheap, so beaten down. We believe there's an opportunity for investors, and that's why we designed the Roundhill China Dragons ETF, DRAG, which launched today to take advantage of that. So for investors who are looking to diversify, maybe they do feel full on the Magnificent Seven, but want to apply that concept to the Chinese equity market, the 9 stocks and dragons, it's a precise, concentrated exposure, can do that for them.
Dave Mazza, Roundhill Investments CEO. Dave, thanks so much for taking the time here today. Just about 21 minutes ahead of the opening bell now. I appreciate it.
Thank you.
Hong Kong stocks taking a little bit of a breather today, this after 13 straight days of gains following a wave of stimulus measures aimed at bolstering the country's lagging economy. To discuss what's next for stocks in the region, we've got Brendan Ahern, who's the CraneShare CIO, here with us in studio. Great to have you here live in living color. All right, so Brendan, as we're thinking about the broader stimulus that's been put into effect in the region and the companies that have been beneficiaries very early on, where do you see this permeating even further from here?
Yeah, I think the key, Brad, is that we've seen the monetary fiscal bazooka unleashed, really geared to supporting the real estate sector, which obviously has depressed prices, have really weighed on consumer confidence, domestic consumption, 2/3 of urban household wealth in real estate. You're also seeing outright the PBOC and CSRC, their version of the SEC, saying, we'll give insurance companies, mutual fund families, brokerage firms 500 billion RMB to buy stocks. If that doesn't get the stock market up, we'll give them another 500 billion. What we haven't seen yet is actually the articulation of the fiscal policy. What are they going to do in terms of consumption vouchers? What are things they're going to do to get domestic consumption up? I think that gets articulated over the next several weeks. So a lot more good news coming potentially.
Brendan, how critical is that just in terms of this outperformance narrative? Because there has been a number of people that have come out, and a number of investors even on this show or strategists coming out saying that what we've heard so far is not enough to really reignite some of that growth within China. Do you think that's true at this point?
I love the skepticism. I love the people still on the sidelines. I love all the people still underweight because this is a super tanker shifting, right? The Chinese economy struggled the last several years. Investors exceedingly overweight. Just 2 weeks ago, we had the Bank of America Mutual Fund survey. Number one position, Mag 7. Number two, short China. So we've only really seen the touch of the fast money crowd, the proverbial hedge fund crowd, pivot back into the space. Think about all of the Q3 investment committee reviews, board meetings, trustees, to move investor sentiment toward China. We're really in the very, very early innings. And then I think you've had the high probability of better news coming, right? Instead of looking through the rearview mirror, let's look through the windshield.
And so JP Morgan is saying, look at other opportunities like in property management. Where else are similar kind of opportunities as you're looking for that catch up into the rest of the rally that's already taken place in China stocks?
Yeah, I definitely think, Brad, right now you're seeing this beta rally. Just, on Monday on the Shanghai and Shenzhen Stock Exchange, you had 5,000 stocks went up. 4 went down. I mean, so this is an everything going up. I think over time, you'll see people gravitate, one, I think, to the growth stocks, and that's self-serving and highly biased, right? We produce KWeb, it's China Internet, it's growth names. But I do think people look at the e-commerce space because that's the transmission engine for domestic consumption as it occurs online. Certainly travel names like Trip.com. I think in general, investors will always come back to the growth stocks, mainly in Hong Kong. For domestic China, where that Shanghai, Shenzhen, I think will be very similar. The CATL, the big battery maker, BYD, consumer discretionary plays, Kichwa Mutai. So I think we kind of think about China as 2 different markets: Shanghai, Shenzhen, onshore China, and then really Hong Kong, offshore China. Onshore China, what do the Chinese think about China? And then offshore, what do foreign investors? So those 2 markets can really move very differently.
So I guess, Brendan, what do you see then the upside then from here? You talk about how investors should be thinking about those 2 markets a little bit, or maybe how they do think about those 2 markets a little bit differently. So then what does that upside, is there still upside room left, at least when you take a look at the Hang Seng and the fact that I think it's up, 27, 30% over the last month or so. Yeah. Is there much more room to the upside at this point?
I mean, in the case of KWeb, we're still 70% below the historical average in terms of the 1-year forward PE. I mean, so that just shows how depressed the evisceration of Chinese equities as an asset class. I think that shows there's a lot more upside. I mean, Chinese equities are 2.5% of global market cap versus it's an 18 trillion GDP, second largest. So I think there's kind of a rectification process that's slowly kind of coming back That'll play out over quarters, even years, but you'd argue there's a lot more upside just if we just get back to where we were historically.
So is what's true and what we've seen for stocks that are specifically either listed in China or primarily operate within the region also true for the companies, US-based even, that have large revenue exposure to China?
Yeah, I think certainly the consumer consumption plays geared to China. Those US and global multinationals will benefit. That the Apple, Starbucks, Yum China. I mean, certainly in the long run, companies like Boeing and ExxonMobil, who have a lot of revenue exposure, they're obviously knock-on beneficiaries, but consumer discretionary plays are what we would anticipate based on the fiscal policy that will be coming.
All right, Brendan Ahern, great to have you, especially here in studio. Thanks so much for joining us. Well, coming up on Morning Brief, we count you down to the opening bell on Wall Street as traders wait for all-important jobs data tomorrow and what that means for the Fed's path forward. Plus, Nvidia to Levi's will bring you all the company stories that you need to know to start your day. And OpenAI clinching a $157 billion valuation in its latest funding round. We break down what the fresh cash means for competition in this space with Wall Street's biggest bull on Meta. All that and more on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code on your screen to track the best and worst performing stocks of today's session with Yahoo Finance's trending tickers page. Well, let's go where the jeans go. Levi shares sliding right now, down 10% here pre-market after the apparel maker slashed its revenue outlook and said it's exploring the sale of its Dockers business. Slow sales in Mexico and weakness in China also weighing on the company's bottom line here, and shares are reacting. There's a lot to dive into with this one. Of course, storied brand in Dockers, not the first time that they've tried to offload that asset here, but more notably here is just the consumer mindset and the environment that this company is going to have to continue to navigate as consumers are really pushing back or being more discerning about their discretionary purchases, especially when it comes to $100 jeans. I mean, I got some recently, but that was my first jeans purchase in a while, and I just direly needed them because the other ones got holes in them.
Well, exactly. It's obviously a consumer story when you take a look at some of the weakness that we are seeing, and obviously from an international perspective as well, with Levi's just one of the latest retailers to come out citing weakness over in China as one of the reasons that we are seeing a bit of a challenge here for the retailer going forward. What stuck out to me was a couple of things. One, some of that weakness in the wholesale business, not necessarily surprising given the fact that Levi's has really been focused on their DTC business, getting consumers to shop at their own stores, on their website, through their apps. But that weakness in the wholesale business, certainly something that the street is noticing here this morning. That declined about 6% in the latest quarter. And then when you go on to mention some of that weakness outside there, you talked about the fact that they're reviewing options for Dockers. Michelle Gass, the CEO of Levi's, is saying that Dockers has underperformed now for some time, and they really want to focus really sharpen their focus on some of their namesake brands and also beyond yoga brands. So I think that that's really important as investors are trying to figure out what the road ahead or what the path looks like for Levi's going forward. But it's a huge move to the downside when you're looking at a drop of just about 11%. And at least some analysts, some of the commentary that I'm going through here this morning are saying that it might just be a knee-jerk reaction here because the core of Levi's brand actually performed well. That was out from Vital Knowledge. And they also went on to say that margins, which outperformed expectations, were actually a bright spot. So yes, there is some weakness within this report, but it's not all bad news here for Levi's going forward.
It's not. You mentioned Beyond Yoga. That was certainly one of the bright spots here, up 19% on a reported basis here. And then you got to come back to the bad side of this. And it's a major question mark over whether or not they need to go full DTC. You think about a brand in Nike that's actually had to reignite some of the partnerships that they have on a wholesale and more broadly a partner basis. And I think Levi's might also have to rethink this as well. They talked about it on the call and actually still saying that they're looking towards this transition and transformation into a global direct-to-consumer business. Michelle Gass actually noting that they're still in the early stages here. They've made progress here. They've got this project called Project Fuel. That's one of their initiatives, and looking towards improving the e-commerce side. But when's the last time you bought jeans online? I like to try on my jeans. Really?
Yeah. I mean, you've
I don't know.
a decent
Maybe
amount,
maybe that's an unpopular opinion. I like to try on my jeans before I purchase them.
Yeah, that makes a lot of sense. I think I'm just too lazy to go to stores, so I order online. I'm very busy, and then I send back the ones that don't fit, and it's a very frustrating process. So I'd probably eliminate some of that from going from the stores, but by going to the stores. But you're right. I think it's a tough time for retail, right? They're trying to figure out how the consumer likes to shop, what the preferences are, and really catering to their business. And this is a decision, a strategic decision from Levi's. But I'm actually laughing to myself because I can't believe we're 2 minutes, 3 minutes into this Levi's discussion, and you haven't even mentioned Beyonce.
I haven't yet. She's got a new partnership with Levi's. Super excited about that. And actually,
that was your story here.
I mean, it totally was. Yeah, I dropped the ball, dropped the hat on that one. She's got a denim hat. We'll talk a little bit more about that with the CFO of Levi's, Harmeet Singh, good friend of the show. We can't wait to ask him about Beyonce, about jeans, about what kind of jeans are popping right now, whether it's the baggy leg jeans. Do you do the baggy leg jeans?
Yeah, you got to.
Yeah? Okay, all right. I do that too. I would never say that you're a lazy shopper, by the way. I see and sit next to you every day.
Yeah, I couldn't brush up on it, you know.
Okay.
Well, Mom Jean era. All right, let's move on to Nvidia. Nvidia shares in the green. CEO Jensen Huang saying that the chip maker is seeing, quote, insane demand for its Blackwell AI processors. The chip is expected to be released in the fourth quarter of this year. You're looking at gains of just about 2%. This is during comments that he made to CNBC during an interview. Not necessarily too different from the tone and demand that he was talking about on the earnings call just last month. He actually used the word incredible when he was talking about Blackwell demand during the last earnings release. So again, you talk about the opportunity here and what exactly that spells out for Nvidia. One of the, I guess, overhangs maybe or challenges, risks that was being talked about ahead of the latest earnings report was any sort of delay in Blackwell and maybe ultimately what that would mean for Nvidia or whether or not that was going to be a challenge for Nvidia in the coming quarters. But when you take a look at that commentary here from Jensen Huang, the fact that he is very confident in Blackwell's full production and demand for Blackwell, quote unquote, being insane, investors, that is enough for investors, at least it seems to be, buying into the stock here this morning.
For most investors, not all. And you got a rare contrarian take here, a downgrade from one firm here, Alizar Advisors. They downgraded Nvidia to neutral from buy here. And one of the analysts pointing out, we've seen for 4 quarters of deceleration, decel, they say, in the sequential data center growth off of huge numbers. That's fine. But the last quarter, sequential growth slowed again. They're now concerned that it can continue to slow in Q3 and Q4. And as customers wait for what you just mentioned, Blackwell may not be in full quarter ramp until the first quarter for the company and could be continued slowdown for the overall data center business, the note saying. So that a bit of cold water here. Well, in some hot water, if you will, shares of car makers, Porsche, Mercedes, and Stellantis, they are under pressure. All 3 automakers getting hit with a downgrade from Barclays today. Mercedes and Stellantis both downgraded to equal weight, and Porsche revised to underweight. The firm citing margin pressures, a tough industry, and the environment there, plus rising competition as reasons for the downgrades here. We've been keeping tabs on all of these companies pre-market, and one of the huge things, and as you're taking a look at Stellantis on your screen, the move on the reaction of this down by about 4.5% as of right now. We've got some other ones to throw up as well. Porsche and Mercedes-Benz also not looking too hot there. They are down by about 4% for Porsche, about 2% for Mercedes-Benz. And it's especially when we think about the consumer environment, there's still more strength, as we were discussing this with Carl Brauer from ICCars.com yesterday, still more strength at the luxury end of the scale here, but there is still more discernment that's being applied even within that end of the market here. And so that's certainly factoring into this decision-making process that they are seeing across the board for some of these luxury automakers right now too.
Yeah, and Mercedes, another company that's mentioning the slowdown in China, that being problematic here. And that was one of the reasons that Barclays downgraded the stock here on that slowing demand in China, although they did make the argument that maybe much of that has been priced in to this point. And then Stellantis, that move lower really caught my attention as a stock that's been under pressure for much of the week as we have been getting some of these updates. But at least from Barclays' perspective, they made the argument that Stellantis was, quote unquote, being too slow to acknowledge its U.S. inventory issue and eroding EU-U.S. market shares. So again, a tough road ahead for some of these European automakers, at least Barclays making that argument. Well, coming up, keep it right here on Yahoo Finance. We've got the opening bell on Wall Street. We'll be right back. Studio here, which is probably what you're.
That's a look at the opening bell at the Nasdaq and at the NYSE. Go ahead and ring that bell. In today's game of Who Rang That Bell, we've got the Italian American Museum ringing the opening bell at the Nasdaq, and on Wall Street at the NYSE, the New York Stock Exchange has got FrontView ringing the opening bell there. All right, we've officially kicked off today's trading session. You've got some funfetti on your right in traditional Italian form in the red, white, and green. All right, let's take a look at the major averages here as we begin today's trading activity. The Dow Jones Industrial Average begins the day down by about 0.3% here. And then additionally, you've got the Nasdaq Composite getting into negative territory here right now. Let's actually put a little bit more of a look on this, and we'll populate this with a chart for you folks at home. Taking a look at the past 3 days, we are down over that period by about 1.8%. So adding on to some of those declines here, the S&P 500, that's over the past 3 days down by a little more than 1% here. The S&P 500 here today down by about 0.2% out of the gate. Let's take a look at some heat maps. We heard you like heat maps and red and green, so we've got plenty of that for you here. 11 sectors in the S&P 500. We've got them loaded up for you here. Energy. Oh my goodness. Look at that. Rapid move to the upside. 0.2%. All right. We'll see if we can add on to that as we go on throughout the rest of today's trading session. Consumer discretionary, though, seeing a little bit of a pullback here this morning. Let's populate this chart for you. Just give you a look at, let's give you a 1 month scale. Why not? Anyway, taking a look at that. Still up by about 6.2% over the past month, 30 days, but here today, down by about 1%. And then just lastly, we'll ride out with a look at the Dow 30 components. That way our own Jared Blickery can take a look at some of the other major moves that we're seeing in the Nasdaq Composite, as well as wherever he would like to take us. But anyway, taking a look at the Dow 30, right now more red than green. One of the bright spots that you're seeing here on the day. You've got Microsoft. It's flat, just barely to the upside. We'll see if we can hold on to those gains. Also, all of the other green moves, there's nothing really moving outsized in positive direction here. Amazon is actually down by about 1.7% here to begin today's trading activity, and so we'll continue to track that. All right. For the aforementioned Jared Blickery, let's get on over to him with a look at what's moving markets. Hey, Jared.
Well, thank you, Brad. Not a lot of action today so far. And in fact, the action this month has been rather negative, but not extreme. So let me just show you the S&P 500. I like how you're showing the past 3 days. That's the month of October, and we're down 1.17%. But if I take a look at the year to date, all we're doing is consolidating right around recent highs. We came down yesterday, rejected support level, and I think as long as we retain these support levels that used to be resistance, we have a decent chance of actually jumping quite a bit higher. However, October is kind of a dangerous month here. I'm going to show you what's going on with the US dollar index first. It is up 4 straight days, and I'll zoom in here. Here's a 3-month chart, and we've kind of reached the place where the rubber meets the road. That would be 102. It punches through there. That's going to be a headwind for equities. If it goes back down, that's a tailwind. So it's kind of as simple as that. Now here's the VIX, and we are in prime time crash season. Doesn't mean it has to happen, but historically, October, a month when things can get a little hinky. This spike here was Yen-mageddon. It was so big, I got to put things in perspective. Here's a 2-month chart. Actually, here's a 1-month chart, and you can see we've been heading higher over the last few days. So higher VIX means potentially spilling over into the risk markets, creating a headwind. And I want to talk about utilities here. A lot of people are excited about utilities because it has been the #1 sector of the year, at least as of the end of September. But here's a comment from Jason Gephardt here. Utilities XLU are trading 20% above their 200-day moving average. That has only happened once before, and that was in October 2000. It lasted 1 day. Here is another observation. Whenever the percentage of S&P 500 utility sector stocks trading within 5% of a 1-year high, whenever that surpasses 95%, in other words, everybody's in the same boat going higher, the extreme overbought condition was likely to mark the end of a favorable period for the utility sector. Yes, I know it's different this time because of AI, but just take all this movement in utilities with a grain of salt. It's very unusual to have them lead this long, and so they might be due for a little pullback because of these aforementioned October headwinds that we might be facing. Here is a sector action. Let's just check in on this real quick. And guess what? Utilities in the green, but tech is the leader. That's up about 0.2%. I'll just check in on the 3-day action to see what's happening in the month of October, jumping ahead there. Energy up 3%. I do want to leave you with an interesting observation. I was looking at emerging markets versus Nasdaq 100, and guess what? Emerging markets, as of yesterday, was neck and neck. It's falling back a little bit, but really interesting to think how emerging markets has just come back so strongly thanks to China. And it really is just a China story, because without, we've seen we've seen EEM and emerging markets dip a little bit. So China's really been the outlier here, guys.
Important gap to point out. All right, Jared, thanks so much for breaking that down for us. A growing wall of worry is building for investors amid escalating tensions in the Middle East, an ongoing port strike that could cost the economy potentially billions of dollars. Joining us now on how to position yourself is Tally Leger. He is the chief market strategist at the Wealth Consulting Group, which oversees more than $4 billion in assets under management. Tally, it's great to have you here.
Great to be here.
On set. So let's talk about that wall of worry. There's a lot of uncertainty. We certainly have seen the escalating tensions in the Middle East. Is that really weighing on the broader market this week? I'm just curious, just your assessment of how big of a risk you see this posing to the market's momentum.
Sure. Well, I think worrying about the risks is probably one of our favorite pastimes as investors. And I think to your point, we've been barraged by some pretty major risks in the headlines just in the past week. I mean, we've been talking about missile strikes, port strikes, hurricanes, elections. And I understand, people might think that this is the most challenging or uncertain of times, but when are they perfectly certain? Mm-hmm. Just imagine being born in 1900 and growing up to witness 2 world wars, a global depression, the assassination of one president.
Spanish flu.
Exactly. And yet, through it all, the stock market has continued its inexorable march forward. So I think you buy the dips here.
And so where are the largest dip buying opportunities right now with volatility spiking the way it is?
Yeah. So we have been, as a firm, kind of taking profits, harvesting gains from some of the big winners like technology, which has done so very well, and reallocating some of that capital into, until very recently, the lagging areas of the market. I like the domestic value cyclicals, like financials, for example, which have been benefiting from these Fed rate cuts, steeper yield curve that's supportive of bank net interest margins, and we've also seen a broad easing in financial conditions. But I also like some of these global cyclicals, including industrials and materials, because of the same global monetary support that we've been seeing, a firming in raw industrial commodity prices, including metals, iron, and of course that's pricing power for some of these companies.
Is it China specifically that you're looking at? We've just been talking about so much, obviously. Do you look at the gains that we've seen over the last several days on the heels of this stimulus? But when you mention international opportunities, I guess more specifically, where are you finding that?
Yeah, I think China is a big part of it. They've pulled a lot of levers. As I say, it's really a global monetary backdrop that we're painting here. And the Fed as well is a big part of it too. And I think the way you play that domestically is some of these global cyclicals right here at home, including the industrials and the material stocks.
What's your outlook as you think about this earnings season that's set to commence next week? We're going to hear from some banks that typically set the tone, give us their kind of meteorological economic forecast for what we should expect in Q4, what they're seeing in the consumer environment. How does the perhaps common denominator make itself known among earnings companies reporting earnings, especially coming off of an extended and pronounced period of everybody just saying AI and just putting the AI button out there?
Right. Well, I'm generally a pretty bullish guy. And what I'm seeing, just looking across the investment landscape, we've got 2% economy or better. Mm-hmm. We've got 2% rate of inflation or slightly less. To your point, earnings, I think, have bottomed for the cycle, and they're actually kicking into a higher gear, and now the Fed's got our backs and is cutting rates. I think it's a pretty interesting environment to be fully invested and participating in this market.
And we talk about earnings being a real catalyst here for the markets going forward. What about the econ data? Because there's lots of questions and maybe some hesitation about what we could see from jobs out tomorrow. Are you confident that the market can continue this rally despite the prints that we're going to get on jobs?
Look, I think as a long-term investor, I'm always waiting for some kind of a pullback because I think it pays to be an optimist. But one of my key indicators right here is the Fed's weekly economic index, because it really gives us a real-time sense of activity across a few major sectors of the economy. It's got stuff in there like rail traffic, steel production, fuel sales, claims, staffing, you name it. It's got everything, retail sales. And some people are pointing to a slowdown. What slowdown? That measure is actually reaccelerating. So again, I think it supports the notion that we're in a mid-expansion pause.
Tally Lejay, who is the Chief Market Strategist at the Wealth Consulting Group. Thank you so much for taking the time here with us.
Cheers.
Coming up, everyone, OpenAI nearly doubles its valuation to a staggering $157 billion. We'll bring you the details next. Stick with us. ChatGPT parent company OpenAI closing out its latest funding round, raising $6.6 billion at a $157 billion valuation. Investors in the latest funding round, which was led by Thrive Capital, including Microsoft, Nvidia, SoftBank, and ARK Investment Management. With us to break it all down, we've got our very own Dan Halley. Dan, what do we know about this funding? How are they going to put this capital to work?
Yeah, Brad, you have to imagine that this is going to go and help build out some of the infrastructure that OpenAI needs, plus the money it needs to continue to operate in general, because it's not cheap to run these kinds of models, nor is it cheap to build them out. So as you said, some of the big investors being Microsoft, Altimeter Capital, Fidelity, SoftBank, Nvidia getting in on the action there, a smaller investment compared to the others. And that $6.6 billion, I think that's going to be something that may go towards something like GPUs. Nvidia obviously being a big supplier to OpenAI. They have a very close relationship. I believe one of the first graphics cards that they used was from Nvidia, and Jensen Huang, the CEO of Nvidia, and OpenAI CEO Sam Altman have a close relationship. And so, you have to imagine they're going to be buying up some of those GPUs. It also goes towards things like power. These are, Jared was just talking about the energy sector being very high on AI. That's something that they're going to have to end up paying for as they bring in more users. But I think one of the big elements here is how they're going to further monetize themselves. This is a good funding round, obviously, with a huge valuation for them. But how are they going to kind of start to bring in revenue on their own? And I think that relates to not just signing up individual users for the pro level to get access to cooler toys in ChatGPT or things along those lines. It means signing up enterprise users. And in that space, there's growing rivalries, whether that's through Google or Amazon. They have their own cloud services, sure, and they do offer access to things like ChatGPT or OpenAI's models, but Google has its own Gemini service. Amazon is working very closely with Anthropic. So there's a lot of rivals out there who are going to look to kind of grabbing those enterprise users. And for now, everybody wants to use different models, see which ones work for them. But at a certain point, you have to imagine that these enterprises will begin to build heavily on individual models. And so OpenAI has to make sure that they can woo a good number of enterprise users to start to really pay their bills on their own.
All right, Dan Howley, thanks so much for breaking that down for us. We want to stick within the tech sector. Big tech companies looking for an edge in AI, including Meta, which plans to spend up to $40 billion on AI investments this year. Our next guest saying that Meta AI initiatives has, quote, moved the stock into Apple's turf and merits Apple's multiple. Let's talk about it. We are joined by Wall Street's biggest bull on Meta, Barton Crockett. He's Rosenblatt Equity Research Analyst, and he has a buy rating on the stock, an $811 price target. Barton, it's great to have you here. So talk to me about this massive rally that you're expecting in Meta. You're looking at shares rallying about 40% from where they're trading today. Why do you argue that Meta's growth merits a much higher multiple?
Well, I think the growth, that's it. I mean, the growth supports the multiple. We think that these guys over the 3-year CAGR are going to be growing EPS, excluding unusual items, over 30%, which we think is supportive of a 30 PE multiple in the most simplistic kind of way of thinking about it. The bigger backdrop, we think, is that people are getting more comfortable with Meta's strategic positioning. Their investments in AI have yielded improved return on investment for marketers, better engagement from users. And this is, they've kind of led and developed this direct marketing to kind of smaller, mid-sized companies globally. This kind of almost new niche that they've pioneered and owned, and they're making these people more productive, and they're spending more, and they're taking share even at massive scale. So we think all of that gets the market, more willing to give these guys a premium multiple. And frankly, I think the big worry on the stock historically has been spending, right? In particular, their investments in their reality segment, which I think are overdone and are not going to generate a return that we think pencils out commensurate to the investment. But they are executing better. I mean, I think that their devices that they were showing off at their recent Meta Connect, they're more resonant with the consumer than even what Apple is doing right now. And their Ray-Ban glasses could actually be something of a hit this Christmas. So all of that, we think, makes people more comfortable, but mainly the growth supports it.
Barton, I was just going to ask you about that. I mean, what type of time frame or lead do you give to Meta in proving to the street that can be a contributor to the financial performance, and that the street should trust future iterations that this company is going to invest in, because as the old adage goes, hardware is hard, and Meta has certainly been looking for the opportunities to, where they don't have a smartphone device, really tap into what could be the next leg or next wave that consumers hop on.
Yeah, I mean, the amazing thing is that they don't ever have to make money in this. We don't assume they do, for the earnings growth to be impressive enough and to support the equity from here. If they did, that'd be a huge upside. They're, we think on pace to lose 17 billion-ish this year in operating profit on reality, and that's going to be more than they lost last year. They probably lost 60 billion cumulatively on this, and yet they're growing EPS at a 30% plus CAGR. So they're so strong in the advertising marketing that they can support, this tax, this basically dreamer's tax on reality, and you can still make a great argument for the stock. So if they can do that, that actually argues that their core business is, even more impressively strong than what you see in the financials, because arguably you can exclude reality, because at some point one would hope that those losses would go away.
Barton, talk to me just about when you mentioned the fact that these AI investments are expected, and they have, I think, to some degree, shown improvement in ad performance. What do you think that upside looks like just in terms of further improvement, and what exactly that is going to unlock here when you talk about how that fits into the valuation picture?
Well, look, I mean, these guys were growing their advertising revenues at a 20% year-over-year pace in the quarter that was reported for June. We think they'll keep growing at close to that pace in the September ending quarter. That's going to put them up at the very fastest kind of growers in advertising. Nearly twice the growth rate of Google, and right on top of what Amazon is doing with their new ad push. And not too far behind the connected TV darling, The Trade Desk, which is probably growing at about 26% as per consensus. So these guys are large, they're growing rapidly, and that's a very profitable growth stream, those advertising revenues. So that's very supportive, we think, for maintaining a really good trajectory in earnings per share growth. And we think that that's what has powered the stock and will continue to power it, which is why, we sit here with the stance that you cited. We have, I think, the street high price target at this point.
Barton Crockett, Rosenblatt Equity Research Analyst. Barton, thanks so much for taking the time here with us today. Appreciate it.
Great, thank you.
Certainly. Coming up, a deep dive into Yahoo Finance's top movers. That's on the other side of this short break on Morning Brief. Welcome back. We're taking a closer look at Yahoo Finance's trending tickers. 3 names to watch. You've got Tesla, Costco, and Bank of America. We're doing it in less than 30 seconds each. All right, first up, Tesla, the EV maker, is recalling over 27,000 Cybertruck vehicles in the U.S. due to delayed rear view camera images. The shares of the company right now, they are down by about 0.3%. Not all of this move today is because of the recall. Of course, it was disappointing yesterday, the results that came out in the third quarter production and deliveries. But what's more notable, perhaps, is that this gives us some insight into exactly how many Cybertrucks have been sold because of this recall. So 27,000 out there in the market here and impacted and need this ultimate update, whether that's over the air or whether they need to go back into a service center. That's continually one of the touting points for Tesla over the years, is that many of those recall updates can be made over the air. But this gives us a little bit more insight into how many are out there on the road.
Just a little bit. All right, let's talk about Costco. This story, it's been a huge hit with consumers, and they're expanding on it for good reason. The wholesale retailer has added a new precious metal to its stores of platinum. It's not doing much for the stock today, off just about 0.5%, but that's not the significance of this story. We have talked about time and time again that Costco has been very successful in selling gold bars and selling silver coins, something that has been mentioned by executives on their most recent earnings calls. So now they're doing it with platinum bars, and you're looking at a price tag of just under $1,100 here. 1 ounce Canada Maple Leaf Platinum coins selling for the same price, both carrying a premium markup of about $94. But if it's anything like the demand that we've seen for their gold bars, like we've seen for their silver coins, this could be a huge hit here for Costco.
I mean,
and they're hard to find. If you take a look at it and you're searching for Google, there's already subreddits. There's so many things that people are talking about. Yes, alerting people of where they can buy them because they're very hard to find.
Wow. All right. We'll put our producer, Nora, on this one. She was on top of the gold bars beat for Costco.
She was.
So she'll be on top of the platinum beat for Costco as well here. Also, let's talk a little Buffy the stock market slayer. Warren Buffett's Berkshire Hathaway is further reducing its stake in Bank of America. Buffett selling shares worth $338 million, according to a regulatory filing year. Shares of Bank of America, as they tend to on any news of Buffett reducing his stake, they are moving lower right now by about 1.2%. I think the critical level, though, is that they still hold just above 10% of the stake of Bank of America. And so ultimately, once that falls below that, they have a less frequent requirement to actually report their trimming activity to the SEC.
All right, well, coming up, keep right here on Yahoo Finance. Much more ahead. We will be getting a pulse check on the economy with ISM services and factory data. That's out at the top of the 10 a.m. hour. We will bring those numbers as soon as we come back. See you on Catalyst. Welcome to Catalyst. I'm Shauna Smith alongside Brad Smith. We're 30 minutes into the trading day. 3 market catalysts that we're watching. Fresh economic data out at the top of the 10 a.m. hour. The port strike as a rising inflation risk, and Levi's lowered full-year outlook.
Investors are assessing the latest economic data ahead of Friday's jobs report. We'll discuss how weakness could change the Fed's rate cut pathway.
Plus, port strikes continuing with no agreements reached. We will break down the risk of reigniting inflation and what this could mean for supply disruptions for big retailers.
And Levi shares, they slump after slashing the full-year outlook. What's next for the stock as the company weighs the sale of Dockers brand? We'll discuss with the CFO, Harmeet Singh, about that later on in the hour. All that and much more.
All right, first we have to talk about some of that breaking econ data that's out here this morning. You're taking a look at ISM Services PMI rising by 3.4 points above all estimates here, coming in at 54.9. Economists now, we're expecting 51.7. And if we could pull up the reaction that we're seeing in the bond market, because I think that's worth taking note of here. But ISM Services Index reaching the highest that we've seen since February of 2023. There was lots of questions in the bond market whether or not an upside surprise would be priced in. So it's important to look at the move here that we are seeing in yields here. We have the 10-year yield right around 381. Employment falling to 48.1 versus 50.2. And also prices paid, that actually rose to 59.4 versus 57.3. But the significance here, prices paid rising to the highest that we've seen since January, Brad.
Yeah, one of the huge things here, especially as we look across the supplier deliveries index as well, registering 49.6%, 2 percentage points higher than the 47.6% recorded in July. The index actually remaining, though, in contraction territory for the second straight month, indicating here some faster supplier delivery performance in August after 2 months of slower territory here that we've been watching as well. And then you mentioned the prices index as well here. One of the major kind of caveats to all of this is how looking through the prices index and that registering the 57.3 that we were discussing a moment ago in August, that's actually an increase from that July reading that we had seen in 57% here as well. We've also got even more economic data crossing the wire here. Durable goods, economists were expecting here. They came in flat, which is in line with expectations. Factory orders ultimately fell 0.2%. Economists were expecting a rise there of 0.1%. Perhaps we can pull up the major averages here just to see how markets are reacting to this economic data. Of course, we've got a slew of economic data this morning or this week. A lot of it has really been focusing on the employment situation, but now with looking through some of the factory orders as well as the ISM data here, markets at least right now for the Nasdaq, that's in positive territory, but the Dow and the S&P 500, as we had seen earlier in today's trading session, not reacting too much, but still in negative territory here as the S&P 500 is hyper oscillating between gains and losses, trying to make up its mind. Also, let's dive into this breaking services PMI data with Tom Porcelli, who is the chief U.S. economist over at PGIM Fixed Income here. Tom, great to have you here with us. Just want to get your read on some of the economic data this week. Of course, this is taking center stage after we got the jobless claims data earlier this morning here, just a little bit hotter than expected. Ultimately, how does this set up for the Fed's decision making come their next meeting in November?
Yeah, so good to be with you as always. Yeah, look, I think in terms of this week's worth of data, I think that there were a couple of pretty interesting things. In fact, I would even say over the last couple of weeks worth of data, I think there've been a couple of interesting things that probably have given the Fed some comfort that they did go 50 basis points. I mean, we've been saying for quite some time that when you look at sort of beneath the surface of the labor backdrop, that there are these cracks that are forming. We've been saying this for a number of months now, and I think a number of the data points that we got this week, I think support that idea. So what are some of them? I think the JOLTS report in particular, it's not so much the fact that JOLTS rose. I mean, it was really funny to me to hear a lot of people say, oh, well, JOLTS rose. Yeah, but JOLTS rose this month in what has been a massive downtrend for the last year. In fact, it rose a few months over the course of the last year in this big downtrend. So that wasn't compelling. I think what was compelling within the JOLTS data is the fact that the quit rate continues to move notably lower, and that is usually a really great sign of confidence or lack thereof for the labor backdrop. And then the other thing is the hiring rate within the JOLTS report that is now back to where we were during the jobless recovery post GFC. So I think there are a number of data points that I think continue to point to look, labor is in the midst of slowing down. Now, that does not necessarily mean that the floor is going to fall out from beneath it. But I think it's certainly argument enough for the Fed to keep on going, and I think to be somewhat aggressive.
Tom, we're seeing this move higher in yields on the back of that ISM services data that we are getting. It's reaching new session highs here, especially in the fact that prices paid rising more than expected. Yep. So here we are at 383, I believe, if we could pull up the 10-year chart here. When we talk about that upside move that we could see in yields, our data is a little bit delayed, but when you take a look at the upside move that we could see in yields, are we talking 3.9? Are we going to push back up against 4%? What do you expect to see in terms of the likely moves?
Yeah, so I would expect that the market remains very choppy, and I think that is consistent with this idea that the economy is in the midst of slowing down. Now, again, I think people hear slowing down, and I think that conjures up these images of recession. We don't think that that's going to be the case. Again, we recognize that there are these risks that we highlighted, but I think in a sort of a slowing backdrop, the process of slowing is not linear. It will come with sort of some good months. And I think, particularly over the last day or two, I think that's sort of what we're seeing. So when I look at 10-year yields, reacting, they're up looks like a couple of basis points post ISM. This to me is, I think, pretty typical of an economy that's in the midst of slowing down. Now, if the bigger question is, where is sort of fair value on 10-year yields? I think that we're probably in the zone of fair value. We're at, again, 383 on 10s right now. I think if you put a pin in this number and, sort of drew a circle 25, 50 basis points on either side, I think that's probably the broader range that you will exist in. But I don't know that there's a lot of big notable moves from here at this point.
So with that in mind, do you believe that we will essentially be able to avert a hard landing or a recession?
Yeah, we do. So, our view has been, our base case has been soft landing. Last year, for this year, we thought soft landing, and we think soft landing for next year too. That remains the case for us. I mean, look, the reality is those revisions that we got from GDP last week, those were notable. I mean, particularly on the income side of the equation. I mean, the saving rate, literally, we just added 200 basis points to the saving rate. I mean, it went from 3% to 5%. That's significant. The consumer, from a balance sheet perspective, in the aggregate, is actually doing pretty well. And so we think that gives the consumer sort of a lot of cushion to be able to sort of withstand what will likely be some additional deterioration in labor from here.
Tom Porcelli, always great to get your insight. Thanks so much for joining us here this morning. PGIM's fixed income chief U.S. economist. Thanks, Tom.
Thanks.
Oil prices continuing to climb for the third day in a row amid escalating tensions in the Middle East, and that, of course, boosting some fears of supply disruptions. Our very own Ines Frey has a look at that move that we've seen to the upside. Ines.
Yeah, Shauna, and if we take a look at oil, we are seeing that it is up about 5% this week, and it's all because of those Middle East tensions. And we are now looking at an intraday of WTI up 3%, Brent crude up more than 2%. Concerns that Israel could retaliate against Iran striking its oil production facilities, also disruption in the Strait of Hormuz. That critical choke point for oil shipments, that's what's driving these oil prices higher. We have seen volatility within the past few sessions with oil spiking, then pairing some of those gains. Why is oil not going even higher? Well, part of that is because of spare capacity from OPEC Plus that's keeping a lid on these prices. Also, the escalation the expectation that is that OPEC Plus will go ahead and unwind those some of those production cuts in December, with Russia yesterday reiterating that OPEC Plus will continue as planned. So they will be adding supplies into the market in December. That's been keeping sort of a lid on the prices. Year to date, you're looking at Brent crude that's up just slightly year to date. WTI up more than 2% year to date. But again, it's this action that we have seen this week that has sent these prices so that you can see where these prices are following those Middle East tensions, guys.
Yeah, absolutely. Throwing a little bit of unknown into the equation, and we see that price reaction in accordance with it. Ines, thanks so much. We certainly do appreciate it here. Guys, coming up, we're taking a look at some of the trending tickers on Yahoo Finance. We'll give you the news behind the moves. That's coming up next on Catalyst.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Eli Lilly's weight loss drug no longer in short supply. The FDA removing Mounjaro and Zepbound from its shortage list, saying they can now meet demand. Despite all that, you're still looking at losses of just about 0.5%. I think the question investors are asking is how big of a catalyst this could ultimately be here for the stock going forward. The fact that supply essentially or theoretically would be able to meet demand at this point. We've seen a bit of pressure here on some of their competitors, Hims and Hers, which is coming out with their version of a competitive product. That stock under a significant amount of pressure today. But again, looking forward here and focusing on exactly what this means for Eli Lilly and the fact that they are able to boost supply. That was the massive concern for investors over the last several quarters about what they were going to do, their new manufacturing plants, how long it was going to take to come online in order to really close that gap between supply and demand. So again, the FDA taking it off that list, and as a result, you're looking at Hims and Hers off just about 12%.
Yeah, those new manufacturing plants going to be more than just trimming fat here. Ultimately, they are saying that they're accelerating their work to discover some new medicines for the toughest diseases, continuing to invest in state-of-the-art infrastructure to support their growing pipeline here. Also looking to supply high-quality medicine for some of the clinical studies as well, which is so critical to making sure that there are multiple use cases that they can find for one specific drug, which is largely the case that's been unlocked for many of the weight loss drugs as well here, proven safe for other efforts here. And so the new complex, they're saying, going to further strengthen the process development, scale up the manufacturing capabilities, very critical for some of the weight loss drugs that they do have in market already, and then the speed of next generation medicines for patients around the world. $4.5 billion they're going to be spending on that. Massive effort. All right, let's talk about something that's not as healthy, drinking. Constellation Brands reporting better than expected second quarter earnings, but missing on revenue. The CEO says the alcoholic beverage company continues to deliver strong performance, but the current macroeconomic environment has weighed on demand. You're taking a look at shares. They are down by roughly 2% here during trading activity here on the day. The beer business, that was solid mid-single digit net sales growth, maintaining some momentum here and the operating margin expansion there. Wine and spirits, not so good though. Ultimately, that one declined by about 12%, driven by what they say was a 9.8% decrease in shipment volumes. The business continuing to face challenging market conditions here, primarily in the U.S. wholesale channel across most price segments in the wine category, and they're not expecting it to get it better anytime soon here. They're actually modeling for this to continue to expect net sales decline of about 4 to 6% and operating income decline of 16 to 18% here. Yeah,
it seems like at least from the early look at analyst commentary and what they're saying following this print, much of that focus being on that beer depletions miss, but it may not all be bad news here for Constellation going forward. Citi was one of the names out there saying that actually from their checks, it seems like scanner data has been improving a little bit, signs of reacceleration in recent weeks. So a real focus on this earnings call. And of course, we're going to hear from the CEO tomorrow. Brian Sazzi has him on the show, but I'm sure they'll be asking just about what that current data looks like and whether or not we've seen any sort of uptick in demand here for the month of September. Then going ahead to the fall football season,
yes,
maybe more people are out there buying some of their preferred alcoholic beverages. And as a result, a name like Constellation Brands very much positioned to benefit from that.
I'm not even a big beer drinker, but I did my part during the last quarter.
Did you?
They can thank me for that.
As always.
Yes.
Do you like Corona?
I do.
All right, there you go.
Gotta have one.
All right, let's stick with, I guess, the name Constellation, but move on to a totally different sector. We're talking about Constellation Energy.
Don't want to drink this one.
You do not want to drink this. Constellation Energy seeking taxpayer backing to help reopen the 3 Mile Island nuclear plant and sell the electricity to Microsoft to power its data centers. That's according to a report from the Washington Post. Now, the loan guarantee request was originally submitted to the Energy Department in May and has cleared an initial review. Shares did initially spike on this news. We're now looking at gains of just about 2%. Clearly, this is a name that has attracted a lot of attention here over the last several days on the heels of this 3 Mile reopening. RBC was one of the names coming out, raising their price target on the stock. And they were saying that it wasn't necessarily a surprise that we were going to see this reopen of Unit 1 of 3 Mile. But going forward, they talked about the fact that the real focus here was just on the future and the concurrent announcement of a deal with Microsoft for the full output of the plan for data center load. That part was a surprise, and because of that, they're getting a bit more optimistic. So again, another movement to the upside here for Constellation Energy.
Yeah, the juice is loose on Constellation Energy right now. You look at the performance over the past 52 weeks, companies up over 160-ish%, right in that ballpark here. And you think back to what companies like Microsoft, what companies like Oracle in their recent earnings calls have been talking about, needing more nuclear reactors to be able to make sure that they can meet some of the demand on these data centers, given the inferencing that takes place within these data center and the large amount of energy that's necessary to make sure that for all of the demand that that data center is going to take on, that they have enough power and juice to be able to pump into those data centers. You're laughing, but it's real. It's real. It's going to happen.
I'm still thinking of your juice is loose line.
The juice is loose. Yeah.
Heard it here first.
Yeah. Well, they've heard it before. Coming up, everyone, a conversation with Levi Strauss CFO about the company's fiscal third quarter next on Catalyst.
Denim giant Levi Strauss trimming its full-year revenue outlook to the bottom end of its guidance. The company also saying that it is exploring a possible sale of its Dockers brand, noting that the division has underperformed in recent years as it looks to focus on its namesake, a Levi's brand. Joining us now is Levi Strauss, a Chief Financial and Growth Officer, Harmeet Singh, along with Yahoo Finance Executive Editor Brian Sazi. Great to see both of you. Harmeet, let's talk about the most recent quarter, because taking a look at shares today, doesn't look like investors are too happy. You're seeing your stock under a bit of pressure. And I think many investors are out there trying to figure out what exactly your quarter tells us about the health and the shape of the consumer right now. So what are you seeing in terms of consumer spending trends?
Good morning, Brian and Shauna. Good to be back on the show. So let me talk a little bit about the quarter and then the health of the consumer. Overall, despite coming in at the low end of our range on revenue, we believe the underlying fundamentals of our business are getting stronger and profitability is improving. So as an example, in quarter three, sequentially, we delivered top line growth in constant currency of 3%. The most pleasing fact was Levi's as a business was up 5%. And that was driven by Europe returning to growth, the fact that our women's business is up low double digit, and importantly, the fact that we are growing and market share both in women's and maintaining market share leadership in men's. Our profitability is also improving. As CFO, one of the metrics I've started looking at is gross profit dollars less SG&A, which really means that for every incremental revenue dollar, how much are you flowing into your bottom line? And that has sequentially improved and will continue to improve. We had some underperformance pieces of our business. China underperformed. We're taking steps to fix that. We had underperformance in Mexico, partly driven by the fact that one of our large customers had a cybersecurity breach. We're working with them to get shipping of our units back in order. And there was underperformance of Dockers. So we're taking real steps to try and focus on them and ensure that we're able to deliver, as we communicated, a quarter four, which is sequentially better, more like a mid-single digit growth quarter. To your question about the consumer, overall, we feel really good about the consumer, despite the macro headwinds and the uncertainty. And that's driven by a couple of facts. Levi's was up. Globally, the denim category is having a moment. Globally, we think the denim category is growing in the mid-single digit. I talked about the fact that our women's business was strong. I talked about the fact that Europe returned to growth for Levi's. US has continued to grow. US, for example, in the quarter was up in the mid-single digit, and we're growing market share. The uncertainty centers around, the sports strike, which we hope, doesn't last too long. The war in the Middle East, the fact that the lower end consumer is probably a little bit more strained, resilient overall, but still a little bit more strained. And so, what we are seeing is brands and consumers are responding to real good innovation and product pipeline.
Harmeet, if the port strike continues, let's say for another week, what does that mean to the holiday shopping season? How much of a negative impact will it be to a Levi's and a broader retail sector?
Yeah, look, what we have done, Brian, because we recognize that this potentially could happen, we have taken some steps. We have balanced our shipments that we're receiving between the West Coast and the East Coast. The other thing is just to ensure that the consumer does not suffer and is able to, have a good holiday season, enjoy the shopping experience. We've air freighted the newer product into the U.S. And so we're doing what we can to minimize the impact on the consumer. But if the strike continues, for longer than a week, longer for 10 days, I think there will be an impact, potentially in December. It probably doesn't impact us as much in our quarter four, which ends in November, but potentially in December, early Jan. So, we're hoping and praying that, this gets sorted out, fairly quickly.
And Harmeet, how does this impact, how do you think about it impacting product pricing? What the dock workers are asking, this is serious raises, potentially up 70%. year over year, or what they're getting paid now. I mean, as the CFO of Levi's, do you think if that does get passed, maybe they get a 50% increase, whatever it is, do you have to raise the prices of your jeans, and when does that start to hit the U.S. economy?
You know, we have done a fairly good job, Brian, over the last 12 to 18 months, protecting the price that the consumer pays for a product, despite, high inflation in some countries where we source product, et cetera, et cetera. So, my view is working with the, ocean freighters and the rest who we have, good relationships with. We believe we'll be able to mitigate some of the product pressures on pricing pressures we have, so that we don't pass it on to the end consumer. The end consumer, at the end of the day, is still getting good value for the products we sell. And so hopefully, like many other things over the last 2 years to 36 months, this doesn't drive higher inflation. And if it does, then brands like us are able to mitigate those pressures so we don't pass it on to the consumer. But we'll work with our freight forwarder companies who we have deep relationships and ensure that we minimize that.
Harmeet, while we have you, thank you for working with Beyonce to answer the question of whether or not I should be washing my jeans here. This is a big partnership, but no doubt being able to capitalize on one of her hit songs and working with the Queen Bee. I mean, what type of Beyonce bump do you anticipate? How does that flow through to the financials? And did you have to, cough up any dollars to be able to partner with such an icon?
So Brad, first a shout out to you. I believe you went shopping a little while ago to buy
I did.
jeans. I'm not going to ask which product or brand you bought, but it's good to see you, move to a casual perspective. To your question over Beyonce, first we're honored that we're partnering with a global icon like Beyonce, somebody who stands for empowering women and somebody who, whose values align with ours. And so our view is, and my view even as growth officer, is this is a win-win for both Beyonce as well as us. Beyonce, as you know, in the first chapter that was released in the photo that you showed, is wearing our 501, and she's wearing the other icon, which is our white tees. Our view is that this partnership reinforces our focus on our women's business is doubled over the time that I've been here. It's close to it's a little over a third of our business. It used to be a fifth of our business, and as we set out to be a $10 billion company, we believe this women's business can double. My wife and daughter are thrilled with this partnership for obvious reasons from that
All of us are, Harmeet.
So, sorry?
All of us are.
Yeah, that's wonderful, and I'm too. And so I think to your question about the impact on our business and volumes, our women's business is having a solid year again. So I think this continues to fuel that momentum. Number one, our icons. Take our 501. Our 501, the franchise is close to $1 billion. Is growing double digit. So I think this accelerates that. And we're really focused on growing our tops business. It's up 8%, but it's still about a fifth of our business. We want to get this business to be much higher. We sell right now, I think, 3 bottoms to a top. They, in the not too distant future, our view is more par with a bottom. So supporting things like tea, et cetera, I think really helps accelerate that.
Yeah, I think Brad's getting me that cowboy hat that Beyonce is wearing for the holiday, so I'm really looking forward to it. Harmeet, before we let you go, that Dockers business, on an annual basis, how much of an earnings drag is it? Because I think that surprised a lot of investors, but if you're able to remove that business from the books, I mean, what does your P&L look like next year?
Yeah, first, Brian, thank you for asking this. A big shout out to our Dockers employees, the Dockers customers and vendors. They've really worked hard to grow this business to where it is. And I know it probably upsets a few of them, but I think, I've been associated with businesses that have spun off, and I truly believe this actually allows both Levi's and Beyond Yoga to focus as one business and Dockers and unlock value for both, different businesses. To your question, it's about 5% of our total business. It is a lower margin business. And so, our view is that, A, this improves the margin structure for Levi's, as well as minimizes volatility, because this business has been a little volatile over the last couple of years from that perspective, and it actually unlocks dockers to go and do what they want to do. It's a global business. International is growing really well. Our DTC business is really growing well. So I think it will help both sides.
Harmeet Singh, always a pleasure to catch up with you, and thanks so much for taking the time. Harmeet Singh, Levi Strauss's Chief Financial Officer and Growth Officer, and our own Executive Editor, Brian Sazi, who will be getting a denim cowboy hat for Christmas. And the
yes, we're going to pass it on to you. Anyway, thanks.
Yeehaw.
Thanks so much. See you soon.
All right. Okay.
Everyone's switching gears and sticking with the port strike. Other retailers are speaking out about the potential impact to their business as workers remain on the picket line, and getting comments from President Biden speaking at the White House earlier saying he's making progress with the striking workers. Brooke DePalma joins us now with a closer look at this. Hey, Brooke.
Yeah, good morning. Many retailers have prepared for this by pulling inventory forward or even switching their inventory or other imports to the West Coast. But based upon how long this lasts, we'll certainly see the impact on retailers and investors, certainly baking in that fear, given that this is now day 3 of the port strike and implications that this could last longer. That's putting pressure on shares of big box retailers like Walmart, wholesale retailer Costco, as well as Target, as well as Amazon. But they're not alone. This is also putting pressure on companies that import from the East and Gulf ports. Now, that also includes big box retailers, furniture sellers, phone makers, and even home improvement retailers like a Home Depot. Now, if you think about these companies and what they have done to prepare, many of them are hoping that it certainly comes and passes quickly, but that's not what we're hearing. We're hearing that this could last as much as 10 days from some experts, while others are saying even longer. Walmart weighing in on this, CEO Doug McMillon telling Yahoo Finance that they have prepared and taken action to try and reduce that risk. But it's important to note here that 80% of the non-food goods sold at Walmart come from the Asia Pacific and international regions. They are the most exposed with these ports being closed here. And also, too, when you think about the type of food or the type of product that is being shipped through these ports, it's perishable goods. And so you think, of course, the bananas getting the headlines, but it's other tree and ground fruits as well. And like I mentioned before, Wedbush analysts saying that even a one-day strike creates 5 days worth of backlog. And one expert saying that if the strike does last 10 days, then it could potentially last through Halloween. And if it lasts through Halloween, he said it's going to be crushing for Thanksgiving Day, Black Friday, and even through New Year's Eve. And so retailers really hoping this is a short impact, but now investors are really looking, hey, maybe this can last longer and impact these companies year end.
Yeah, Brooke, how big of a challenge do you see this being as we enter another round of earnings season, and retailers are historically the last to report here, and we're expecting that again. But as we do hear a bit more commentary just about the challenges and maybe headwinds that this does raise for some of these names like Levi's, Walmart, Nike commenting on it on their most recent earnings call. What are you expecting to hear just in terms of some of those strategic adjustments and maybe what they are then further doing in order to try their best to eliminate this risk?
Well, what's been interesting is that for the past few months, since June, we've been hearing from these retailers saying that, hey, we adjusted our imports, we're shifting balance. What Levi's CFO just said, we've shifted balance to be balanced between imports on the West Coast and East Coast. But now what we're hearing is, especially from Nike, that, hey, we haven't actually baked anything in yet because we feel like we hedged ahead of this port strike. But we're going to have to wait and see to see how long this lasts, see how much it impacts. And also we heard the same thing from Costco, that really they hope that it sort of passes quickly and they'll sort of adjust as time goes. One important note here, though, many have prepared ahead of the holiday. But if there's a big ticket item that's hot and it sells out really quickly, the chances of it getting stocked back in inventory may be slim to none.
All right, Brooke, thanks so much for breaking that down for us. I want to turn to the latest on oil. Coming up, some oil traders seeing prices reaching $100 a barrel on Middle East tensions. We will talk with an energy analyst about Wall Street's latest bet next. prices spiking today amid comments from President Biden at the White House. President Biden saying that there are discussions about Israel striking Iran's oil facilities. To discuss, we want to bring in Scott Shelton. He is energy analyst at financial services firm TP ICAP. It's great to have you here, Scott. As we take a look at the price of oil, once again spiking today. Again, we're just getting those headlines from a commentary here from President Biden. You're looking at crude now above $76 a barrel, crude at $73 a barrel. You have Brent at $76 a barrel. Scott, what does that upside look like? We've been hearing more and more talk about $100 a barrel oil. Is that realistic?
I think there's always a risk of $100 a barrel. Certainly, we've seen a fair amount of buying of $100 strikes across the last couple of days. I think yesterday's Brent options was for calls was a record. But I think it's more about hedging the upside than actually think it's going there. I mean, certainly when you talk to the oil traders, they see a ton of spare capacity available. I think Saudi Arabia's got 3 million barrels. UAE has 1.5 million barrels. I mean, Iran's been exporting about 1.5 million barrels a day. So, I mean, there's a general skepticism from people that prices can go to $100. I think the types of clients that we're seeing buying the upside options are more or less buying insurance policies. I think certainly there's a lot of equity length out there in the market currently, and $100 oil prices would be bad for their portfolio. So we see a lot of hedging. I don't see strong opinions, though, that we're going to 100. I think it's more of a fear.
To what extent is, and of course the geopolitical concerns are really getting priced into the market right now, but then you also got some of the other international activity in Libya restarting their production as well here. And so, to what extent is that offsetting some of the larger concern that's clearly playing out on the geopolitical front?
Oh, I think it's a very important part of the balances that Libya is coming back. We run numbers for what inventories are going to do in the fourth quarter. And before Libya came back, we had draws, which would bring us down to perilously low levels. And I think by adding Libya back, those draws are now gone and we have small builds. So I mean, certainly it's important. So yeah, it's significant that Libya is back.
Scott, when we talk about some of these risks, the geopolitical risks, you also talk about the stimulus in China right now, how big of a boost that could be for demand. When you're trying to evaluate, I guess to get to the crux of my question here, you're trying to evaluate some of these outside factors, geopolitical risk factors, fiscal policy type of factors outside of the U.S. How are you factoring that into your modeling? And I guess as we have seen the U.S. become a larger and larger producer, are those types of developments maybe less relevant than they were 3-5 years ago?
Well, I think they're certainly less relevant because of U.S. production growing, certainly to the U.S. exposure to being short oil. When it comes to looking at the geopolitics side of the market, I tend to think in terms of risk premium. My fair value for oil is probably someplace in the mid 60s for WTI, closer to 70 for Brent. And I think we just added a risk premium to the possibility of a loss of production or perhaps a loss to refining capacity in Iran should Israel attack. When I think about China, certainly the stimulus has been something that's been significant for other commodities, but it really hasn't been for oil. The current growth that we're seeing out of China is just not significant enough to get the balances to turn positive, even with the stimulus. So while other markets have reacted, I don't think oil has, just because should Chinese demand even double, I still think the 2025 balances are actually still pretty weak, especially when you add all the OPEC spare capacity that's due to come back on.
Yeah, Scott, I guess how big of a spike in demand would you need to see in order to change your thesis and your outlook there?
Oh, I think we'd have to go back to the 1.5 million barrel a day type of demand growth which we saw for years up until this year, just because China's demand growth just hasn't showed.
Which companies are set to benefit the most right now as you think about how Exxon, how Chevron have all within some of the prices that we'd seen hit lows, or at least 12-month lows, over the past month and a half. We were speaking with the vice chair of Chevron about that, and now we're talking about $100 a barrel being a reality again, potentially. With all of that in mind and those projections, how are these companies set to benefit, and where should investors be placing their attention?
Well, certainly, I would think the E&P side of the business would benefit from $100 oil, and I think refining margins would get pressured, which is not good for the refiners. Just to preface this, I'm not a equity analyst, so
Sure.
It's not necessarily my strength, but I think there's a ton of spare capacity out there on the refining side, and should you get a squeeze in oil prices, I don't think product prices would follow. So refining margins would get hit, and refiners would suffer.
All right, just had to bring it into some of the energy companies that we're also tracking
Sure.
here as well. Scott, appreciate you entertaining the question, entertaining the time as well here. Energy analyst over at TP ICAP. Appreciate it.
Thanks for having me.
Thank you. Guys, coming up, could OpenAI's massive funding round raise antitrust concerns? We speak to an expert about that next on Catalysts.
OpenAI confirming it's getting a $4 billion credit line on top of its latest funding round that gave the company a $157 billion valuation. The funding round, including investors, Thrive Capital, Microsoft, Nvidia, SoftBank, and much more. OpenAI reportedly asking these investors not to fund some of its competitors, including Anthropic and Elon Musk's xAI. That's according to a report out from Reuters. We want to bring in Sultan Megji. He is the co-founder and CEO of Frontier Foundry. He's also the former Chief Innovation Officer at the FDIC. It's great to have you here on Yahoo Finance with us. So talk to me just about the sheer valuation of this company, $157 billion. What do you make of that, and what does that signal here for the future growth of OpenAI?
Well, it's the largest private funding round in history. It's a massive valuation. And if you're a VC and you're doing the math on this, it's, rough order of magnitude 2 to 3 times what their actual revenue would support. And so there's a lot of energy behind it, a lot of emotion behind it. But like has been reported and what you just commented on, there are a bunch of the investors in this round who are looking for them to really get their revenue higher. I would have expected to get to the kind of revenue they have now to be, basically double to support the kind of the kind of revenue or the kind of valuation they're getting, but it does put a lot of pressure on them, especially with all the staff departures that they've had recently. And it's frankly going to take a lot of energy for them to get there.
How critical was it for OpenAI to say that they were willing to and were exploring and are planning to change to a for-profit status in order to lure in some of these new investors?
We don't know the full extent of that, but it was absolutely required. We know multiple investors required it, and multiple investors also are saying that they have to hit revenue targets to come back. And so this is a real reset for OpenAI. They are now aimed at being a massive artificial intelligence product company. Everything else becomes secondary, and we've seen that just in the last week or two with a couple of more recent product announcements. And we're going to start seeing them have a far stronger focus on revenue, especially enterprise revenue.
Sultan, when you talk about some of the capital spending that's going on right now, there's lots of questions, I think, about the rate at which OpenAI is burning money, why they're burning money, quote unquote burning money, at such a fast rate. Can you give us any insight just about what this stage of OpenAI looks like inside their walls and why it is that we see that cash burn rate so high?
Yeah, so it's a great question. They were coming into this fundraising with I think it was about a $5 billion shortfall, and so they really needed to get this fundraising done. And it's because they're spending a bunch of money in a couple of key areas. The first is around regulatory management. There aren't a lot of regulations here in the United States. They are spending a tremendous amount of money on lobbying to help shape AI regulation. They're also spending a huge amount of money on people, similarly to companies like Scale AI, which are using a huge number of people to manually do data management work. And then, finally, they're really trying to build revenue and justify the valuation. They're on a clock now, and it's not clear if it's a 12-month clock or a 36-month clock in order to justify the kinds of numbers that we're hearing. If Apple only had, $3.5 billion in revenue, we would not call it a $1 trillion company. OpenAI wants to be a $1 trillion company, and they are going to spend as much money as they can as quickly as possible to get there.
Is this a company that is marching towards some type of legal action on the antitrust front, given that they're telling investors that, hey, they can't engage with XAI, of course, of Elon Musk fame, and then Anthropic of Amazon fame?
Yeah, it is a huge question here in DC. Even before we saw the investor list for this most recent round, there were a lot of concerns about just how massive and how overwhelming OpenAI already could be in terms of its competitive pressure, just because they spend so much money buying up people. And I think, especially if you look at Nvidia, you look at Microsoft, you look at SoftBank, and you look at Thrive, which led this round, these are all companies that are key to the current generative AI ecosystem. And there are really two categories of AI firms out there right now. They're the ones that are 5, 6, 7 years old, like OpenAI, and then there are the ones that are less than 24 months old. And not being able to invest in the more modern technologies of the newer companies, I think it's raising a lot of eyebrows on the antitrust side.
Sultan, what do you think OpenAI is going to look like 5, 10 years from now?
That is an absolutely fantastic question. There are really three possible outcomes. Number one is they are in that rarefied category of the biggest of big tech, like a Microsoft and Apple and Meta and Alphabet. And it is just a key component of artificial intelligence. There is a second option where some degree of M&A activity occurs, and you see them get bought by an Apple, or you get them bought by Microsoft, or whomever, or you see somebody try to put Nvidia and OpenAI together, which I think would certainly trigger antitrust here in the United States. And the third is that just like in the 90s and in the 2000s, whether we're talking about first generation e-commerce and internet and internet search, or we're talking about cloud, the Ask Jeeves and Alta Vistas, big, massive companies then kind of disappeared after 5 years. AOL is another example of that. But one of those three things will happen with OpenAI. It's just a matter of, will they be able to execute well enough and build a product that can get to the kind of enterprise revenue they need, so being able to operate in secured enterprise environments, to get to the kind of dollars that Microsoft gets on a daily basis.
Sultan, always a great pleasure to grab some of your insights here with us. Sultan Meghji, who is the Frontier Foundry co-founder and CEO. Appreciate it.
Thanks for having me.
You know, it's really interesting here, especially as we continue to ponder what this ultimately means for OpenAI. It's important to remember, as Sultan was pointing out, that there is no install base for OpenAI. They don't have any hardware. This is purely right now search engine application software built on top of language learning models. And this requires a lot of people and wooing new talent over there. And it could potentially be an effort, at least within this most recent fundraising round, the ability to have a tender event where current holders of OpenAI private shares are able to actually put those into the private market as well for sale.
Yeah, I think there's just so many questions about what the future is going to look like for OpenAI. And it's why I asked him what he thought it could look like 5 to 10 years down the line, just given the massive growth that we've seen, given the interest that we have in OpenAI, given the fact that it seems like almost every day or every other day we're getting a massive headline out at OpenAI, whether or not it's about the direction of the company, whether or not it's about their leadership, whether or not it's about future investment and where some of that interest is coming from. So I think we're obviously very much in the early stages of OpenAI, and it's going to be exciting to watch that growth and see that future investment and what ultimately that brings here for the economy, for the society, and everything moving forward here with Sam Altman at the helm.
I wonder what the ChatGPT result is for whether or not you should wash your jeans here. Everyone, coming up on Wealth, dedicated to all your personal finance needs. I've got you for the next hour. Oh yeah, you're in luck. Stay tuned.
3 hours.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, we're going to discuss the biggest financial planning items for investors to consider heading into the end of the year and prepping for 2025. And Trump versus Harris. Which presidential candidate is better for housing affordability? We'll see what the survey data says and discuss how Americans are feeling about the election and their personal finances. Plus, your rich BFF. Don't miss our interview with Vivian Tu, who made the transition from Wall Street to your social media feeds to help give you financial tips and the tricks to get rich, ultimately. That's coming up later on during today's show. But first, as we always do, we got to take a look at the U.S. major averages. Got them here for you on screen. Right now, we're down across the board. Traders, they're awaiting the September jobs report. That is coming tomorrow, Friday. While tensions in the Middle East dampen investor sentiment. To discuss what risks might be ahead for the markets, we've got Brian Bendig, MJP Wealth Advisors, Chief Investment Officer. Brian, great to have you here on the program with us. All right, so we've laid out a lot of what's at play within this market right now and the environment as we kick off the fourth quarter of the year. How should investors really be evaluating this range of issues, from geopolitical tensions to port strikes, to the policy pathway that the Fed is going to be continuing, we expect, once we get into November and beyond? What is carrying the most weight?
Yeah, thanks, Brad. I mean, look, the month of October always historically has been one of those more volatile months, and especially with all those variables that are out there. I think going into earnings, it wouldn't be surprising that the volatility levels, which have spiked over the last couple of weeks, continue on until after the election and through the beginning of the year, just due to some of the uncertainty coming out of Washington to see what sort of policies they're going to deal with in the future. But I think at the end of the day, just to keep it simple, Brad, it comes back to earnings. And so earnings outlooks for the balance of the year are still robust. Earnings contributions coming from areas expected outside of tech is what we see in the numbers. And we're also seeing decent earnings, even though expectations have come down a little bit for next year, still growth going on. And behind the scenes, we still have an economy that's chugging along, granted slower growth, but growth is good. And stabilization, you're right, labor markets have a big report tomorrow. But again, stability there as well based on some recent indicators. So I think investors need to look past some of the short-term emotional responses to some of these variables and come back to the fundamentals longer term.
You know, it's interesting, and I'm looking at some data from FactSet here while we have you, Brian. For Q3 2024, the estimated year-over-year earnings growth rate for the S&P 500, 4.6%. If 4.6% is the actual growth rate for the quarter, it would mark the fifth straight quarter here of year-over-year earnings growth for the index. What are the anticipations, though, for the broadening of earnings growth as you've been tracking?
Yeah, I think that's a great point. We know we have the Fed obviously cutting rates full 1% this year, outlook for rate cuts next year, another 1%. And with the earnings growth that you mentioned, Brad, we think that's going to help the cyclical parts of the economy. I'm talking about industrials, I'm talking about financials, I'm talking about infrastructure, healthcare, and even some of the smaller companies out there in the small cap space and medium space. So I think it's what we're looking for is more of a balance, because we know the story. Disparity of returns have continued consistently through the first half of this year, all of last year, with our friends in mega cap tech, with the AI innovation trend continuing to play out for many years. That's still going to be there. But it's nice to see that there's contributions coming from other areas of the market, the other 495 or 93 stocks, depending on how you measure it, outside of those big mega cap names. And I think that's what's really necessary to support these valuations where we are right now. Because when you strip out mega cap tech, the S&P 500 on a forward PE perspective is pretty close to historical averages.
And so with that in mind, as I was mentioning at the top of our discussion here, we are in the last quarter of the year. How should investors be looking at their retirement investments and overall asset allocations, knowing that we have so many significant events that are all coming to this intersection at once, seemingly, in this final quarter?
Definitely. Well, I think it comes back to this whole concept of when you think about financial planning and life cycle planning moving forward, it's controlling the things that you can control that lead to better outcomes that everyone can collectively celebrate. And one thing that we know is taxes is something that is a topic, Brad, that most people don't want to pay, right? We know that. And to have some tax avoidance in your financial plan and your investing plan is really key and something that we talk about with our investors. So here we are in the fourth quarter. Take a look at how much you've contributed to your retirement account through work or on the personal side that might lead to a tax deduction that might help in managing the costs of living through taxation. Also think about municipal bonds. The Fed has still given us a gift, even though interest rates have come down. The municipal bond market is less volatile than stocks. We can still get some really attractive yields there, and you don't pay federal tax when you invest in municipal bonds. And in a taxable account, having that income come into the account to be reinvested or help to support living expenses is a really nice benefit. And I would say lock in those rates now before we go through another 1.5% of rate cuts over the next 15 months. And I think at the end of the day, have a plan is what I'm saying real simply as we reflect coming into the end of the year and you think about next year. Put some of those short-term versus long-term goals out there and try to prioritize accordingly, because I think at the end of the day, we're all so busy and we always react to things. But if you can have a plan and have a little forethought, I think it helps to improve your probability of success.
Brian, thanks so much for taking the time here. I mean, you've got Yahoo Finance baseball Slack lighting up right now, trying to figure out what ballpark that is behind you. Our best guesses were in Minnesota at Target Field, so you can confirm or deny whether that's true here. But ultimately, whoever you're a fan of.
Citi Field. We're rooting for those Mets.
Citi Field. Wow. All right. That's going to appease some people in the control room. Brian, we knew you wouldn't let us down. Brian Vendig, MJP Wealth Advisors, Chief Investment Officer. Thanks so much, Brian.
Thank you.
An increasing number of women are investing in the stock market, but they are also more likely than men to lack confidence when it comes to investing. Yahoo Finance's own Carrie Hannon is here with a closer look at the data. Carrie, what have you found?
Hey, Brad. Yeah, there was an interesting study came out from Fidelity today that shows that, 7 in 10 women are investing in the market, in the stock market, outside of their retirement accounts. And that's up from 60% last year. So it's on the rise. And boomer women are really getting rolling too. They're up 23% of these women, boomer women, investing in the market outside of retirement accounts. And the overall number is something like 9.5%. Of their paycheck after the retirement savings is going towards investing in the stock market for all women. But the ones who are really on a roll are Gen Z. Okay, these are workers in their 20s, and they are uber optimistic. They are setting aside about 10.4% of their paycheck after the retirement savings, and they're starting earlier, which is so exciting for in terms of building wealth for women. That where boomer women really didn't get rolling and investing outside of their retirement accounts in the markets until they were in their 50s. But here's the problem, just as you noted, Brad. Women say that they're 2 times more likely than men to say that their investing knowledge is non-existent. Okay, this is really troubling. And they say that they're overwhelmed, they're intimidated, and all of these things, it's a mixed bag here. So, I recently sat down in the Yahoo Finance studios to talk to a panel of women who are experts in the financial world about how far women have come in the past 50 years since the passage of the Equal Credit Opportunity Act. Let's listen to what they had to say.
Well, it's so important to recognize that financial independence is not solely based on the amount of money you have, but the access to tools and things that help you achieve freedom and autonomy in your life. And so with this act and with the power given back to women to be able to have more opportunities, more destiny, they hold their own destinies in their hands and can make those decisions. I mean, it's trickled to me and be able to obviously charge my path, have a career the way I did have a career, and then become an entrepreneur in the way that I'm talking about financial freedom and independence to help women like myself who want to achieve that freedom and autonomy in their life.
Carrie, that was really interesting, and we know that you can catch more of that panel, our viewers can catch more of that panel Saturday, 11:30 a.m. Eastern, right here on Yahoo Finance. Carrie, I read your story here, and I thought it was particularly interesting to break down generationally as well here. While we do have you, I want to switch gears, though, to Social Security. As we're thinking about different generations, should someone who just turned 70 start claiming their Social Security benefits?
Yeah, it's a great question. And the simple answer is why not? Because the way the system is set up is that, yes, you can start taking your benefit at age 62. And then you have your full retirement age, which could be 66 or 67, depending on the year where you were born. But then at age 70, and so if you wait 62 to age 70, your benefit increases each year, and that amount will be, as you know, by the time you get to 70, it's not going to increase anymore. So there's no reason not to take it at age 70, and you will get the biggest check for the remainder of your life if you can wait till age 70. That's what I usually recommend people do. Obviously, not everyone can do that because of health reasons and financial reasons, but if someone's at age 70 and they're going, hey, should I turn it on now? Yeah, why not?
Carrie Hannon, thanks so much, and look forward to catching more of that special later on this week. Appreciate it.
Thanks, Brett.
Coming up, everyone, a fresh read on the labor market, what industries are seeing the most job cuts, and how many are being blamed on AI. Stay tuned. You're watching Yahoo Finance. Wall Street is focused on Friday's hotly anticipated jobs report, and we're here with everything that you need to know ahead of the data. The Street is expecting the unemployment rate to remain steady at 4.2%, and economists expect the U.S. economy to have added 150,000 jobs in September. That's more than the 142,000 added in August. And finally, of course, we'll be watching for the average hourly wages month over month to come in at 0.3%. However, investors have had a lot of jobs data to parse through this week. Initial jobless claims were published today, and more Americans than expected filed for first-time unemployment benefits. But the 4-week average declined. Historically, we are at low levels of layoffs. And earlier this week, we saw job openings unexpectedly rise in August. The same report showed workers are becoming increasingly wary of searching for new jobs amid a slowing labor market. The quits rate, a sign of confidence among workers, ticked down to 1.9% in August. That's from July's 2%. That marks the slowest pace since June of 2020. ADP data, also known as private payrolls, showing better than expected growth. All that to say, we're seeing a mixed picture of the labor market. But why is this important? People are tracking these data points as indicators on the state of the economy. And if there is weakness in employment, it's a big red flag. Slow demand here for labor means the economy is not growing, and more unemployed people means less spending, which hurts companies, not to mention all of this will factor into what the Federal Reserve will decide for the future of interest rates. But for now, at least, the job market may not be too bad. Turning now to another read on the state of the labor market, a new report from Challenger showing employers announced nearly 73,000 job cuts in September. That's a 4% decrease from August, but it's actually up 53% compared to September of last year. Joining me now with more insight here, we've got Andy Challenger, Senior Vice President at Challenger, Gray & Christmas. Andy, always a pleasure to read through some of these stats that you're able to kind of comb through and parse through and ultimately bring to our attention here. So what do you believe is the reason for the delta that we're seeing right now in this year-over-year move higher, but ultimately kind of the more pressing figure in that month-over-month?
Yeah, that this month compared to the same month last year can be really volatile. So we don't put a ton of meaning behind that. Overall, what we've seen is that layoffs this year are about the same in terms of announced job cuts as they were through the same period last year. We're not seeing a huge spike. Last month, we saw a big increase after a trending down of job cut announcements. So it worried us that Fed was acting too late, that the labor market was showing signs of cracking and accelerating into a downturn or a cooling turning into a freezing. But what we're seeing in the data this month is that it's a little more gentle. It's about where we'd expect to be. And for us, it's hopefully a sign that the labor market is just kind of stalling right now where it is at until the increased interest rates can start to warm things up. We really don't want it to fall much further than where we are right now.
And then on the other side of the job cuts, you've got hiring that's really come into focus as well here. What are you noticing within corporations as they are on one side trying to figure out where they need to institute cuts, but on the other side trying to figure out where there are jobs that can be added into or maybe even reallocated within their workforce?
Yeah, hiring's always one of these numbers that's kind of moving up and down with firing. They're not 100% correlated with each other. Sometimes organizations are bringing in new business units while closing others just to adapt to changes in their industry. Right now, we're not seeing really dramatic stories in either direction. For us, most of this data is showing us, at least right now, a relatively calm period. It could always cool further than this. It could always start to heat back up again. But for right now, hiring, we saw job openings go up a little bit this month, which is good. Sentiment around jobs fell. We saw people less likely to quit their jobs last month. It's usually an indicator of how strong they feel the labor market is. So while that metric has cooled a little bit, companies are still adding jobs to their payroll.
And so with that payroll in mind, it was interesting in the ADP data that we got this week showing that the difference is narrowing between the job stayers and job changers and the wages that they are getting ultimately here. How is this all passing through in the data that you're tracking through to wages and what that compensation package looks like?
Yeah, that's such an interesting point, right? We really were seeing during the labor shortage years of 21 and 22, the vast majority of wage gains going to job switchers, something like 15 or 16% of wage increases were going to them, or they were seeing a 15 or 16% increase. Now that's closed down to just about the same as if you're staying at your organization. So I think that's also making people less likely to quit. Not only are they worried that that there could be a crunch coming in the labor market and they should try to shelter in place, they're actually not even seeing the same gains if they take the risk to go out to an organization that they were just a few years ago. So people are reacting really appropriately to the labor market forces that we're seeing out there.
You know, within this data as well here, I wonder to what extent, I mean, we always talk about, hey, AI is taking our jobs, AI is taking our jobs, but is that showing up and to what extent?
Just a little bit. It's not nothing though. And I think that's something to take note of. We saw last year a number of announcements related to AI job cuts, and every time a company made that announcement, it got headline news for 2 weeks. Companies were really pulling back, using any language about artificial intelligence and job cuts. However, we start to see that creep up again this year, especially in the context of restructuring and organizations that are looking at their operations teams. So an area where AI might be able to come in and do some of the rote work that there are people doing right now. When I talk to employers, most of the time they're still saying augmentation, right? It's going to help their current workers, they're going to be more productive, but we're seeing little pieces of information here and there, even though companies are reluctant to talk about it, that AI might be reducing some jobs in some companies.
Andy Challenger, Senior Vice President at Challenger, Gray & Christmas. Andy, great to grab some time with you here today. Thanks so much for breaking down this data for us.
Thanks for having me.
Certainly. Guys, coming up, it's time to get rich. Let's do it. Vivian Tu, co-founder and CEO of Your Rich BFF, joins us. We've got all the financial tips, tricks, and hacks that you can think of, and we'll dig into her illustrious career. Stay tuned.
If you're in your 30s and 40s and think it's too late to be rich, you're wrong. I'm Vivian, your rich BFF, and your favorite Wall Street girly. Here's what you need to know. I'm a multimillionaire, a former Wall Street trader, and a personal finance expert with all the credentials to prove it. I'm teaching you all the finance you didn't learn in school. Rich people use a secret investing hack to get crazy hidden travel perks. Here are my favorite top 3 credit card perks that you didn't know about. 3 really good money-saving tips to make sure that you have the best wedding possible without breaking the bank. What if I told you I had a trick to potentially save you even more money? Welcome to Rich Talk. It's the first day of 2021, and I, your new rich BFF, am going to teach you ways on how to grow your wealth with my best financial literacy tips and tricks.
Vivian Tu, known on the web as your rich BFF, has grown millions of followers since creating her first TikTok on January 1st, 2021. Vivian's mission, to make personal finance accessible to non-experts and marginalized communities. Joining me now on set, we've got New York Times bestselling author and founder and CEO of Your Rich BFF in the flesh, Vivian Tu. Vivian, great to have you here with us in studio.
Thank you for having me.
Absolutely. Let's start with your career on Wall Street. I mean, what was it like and what pushed you to change your path here?
Yeah, I think like so many young people, I wanted to come to New York, pursue something that was exciting and sexy, and I also wanted to make a lot of money. And so I started my career on Wall Street. After a couple years, I wanted to make the pivot and do all of those things, but also wear ripped jeans to work. So I pivoted into tech and media. And when I got there, all of my new friends wanted me to explain finance to them. And I was able to do so through, hey, this is how you rebalance your 401k. This is the health insurance plan that may make most sense for you. But I put my very first TikTok video up on January 1st, and it went viral, 3 million views, and by the end of the week, I had 100,000 followers.
That's one heck of a New Year's resolution that paid dividends very quickly
That's right.
as well here. I mean, what advice do you have for people looking to make career changes and pivots just as you have?
Do it scared. I think a piece of criticism that I hear all the time, it's like, oh, I don't want to go back to law school because it's going to take 3 years. I don't want to try a new career because it's going to take me 2 years to get good at it and I'll be behind. Well, 2 years, that time is going to pass anyway. Would you rather still be in a dead-end job that you don't like or have gained the skills that you really care about and have a career that you love? Just do it scared.
All right, so let's get to the financial advice here for our viewers. I mean, what is your top piece of financial advice that you like to convey to either the followers on social media or just those who are trying to make a difference in how they are investing even?
Yeah, I would say it's critically important that you don't attempt to cherry pick the perfect stock or the perfect investment. As someone who has worked on the street, we would get phone calls pretty regularly of hedge funds being like, hey, we made a couple bad calls, like we're blowing up, like we got to unwind all of our trades. And if funds like that have very literally billions of dollars of technology and resources at their fingertips can't seem to get it right year after year, what makes you think you can? So I always say just invest in a diversified portfolio that is risk adjusted and makes sense for your age and your financial situation, and buy and hold. Hold it for the long term, and that's the easiest way to invest.
What about savings? I mean, on one side you've got investing, and then on the other side, hopefully you take some profits over time. You figure out how to put that into a good savings account and let that accumulate as well here. So what are your savings tips that you're telling people right now?
Yeah, I think folks are saving, but they're not doing it correctly. They are putting their money into a traditional savings account at a bank, a brick and mortar on the corner. And unfortunately, many of those are offering APY earnings of interest every single year, anywhere between 0.01 to 0.07%, which is nothing. You get pennies, if that. However, there are high yield savings accounts out there right now, specifically online banks that don't have those overhead costs, that are willing to let you earn more interest to acquire you as a customer from a brick and mortar, and they're letting you earn anywhere between 4 and 5% in interest every single year on your money. And that is meaningfully better. And why would you want to earn less when you can earn more?
Your name is Rich BFF. I mean, tell us, how can someone think about instituting little strategies, perhaps in the margins of their time to begin, in order to make sure that they can create either more streams of income, or let's just be frank, just get rich?
Yeah. To that exact point of having time on the margins, we're all busy, right? And I think I've acknowledged that you must invest to get rich. You can't save your way to rich anymore. But people are like, okay, well, when it comes to investing, I gotta pick the account. I gotta, fund it with the cash. I gotta then pick the investments. And it's a long process, and people get scared and they get paralysis by analysis. They're like, what's the perfect thing? What do I do? Just get a robo-advisor. You don't have time for all that. So with a robo-advisor, all you have to do is find one that suits your needs. You take a quick money quiz about how much you earn, how much you have, how old you are, what your life looks like, all of these details about you. In the same way that Spotify can put together a playlist that makes sense based on your listening history, a robo-advisor can take your financial information and then spit out a diversified portfolio that makes sense for you, and it all happens within 45 minutes, and you're invested.
Let's get personal here. We understand that you recently went on your honeymoon. Congratulations
thank you.
on getting married. Talk to me about budgeting for a wedding and a big vacation like a honeymoon.
Yeah, I would say making sure that you understand what you value is really, really important. A good friend of mine, Paula Pan, has said that you can afford anything, just not everything. And it's critically important to know that. So maybe you want to stay at that 5-star resort. Maybe you're going to have to fly economy. Maybe you want to fly first class. Does that mean once you get there, you have to kind of piece together the trip versus having one that's fully planned out by a travel guide for you? But see what you value and spend your money that way. And when it comes to planning a wedding, it's still very similar. What makes the most sense to you? Do you want to spend on entertainment, or do you want to spend on food? Do you want to spend on flowers, or do you want to spend on attire? But pick what matters to you and spend there.
Vivian, great to have you here in studio with us on Yahoo Finance. Vivian Tu, founder and CEO of Your Rich BFF. Great to see you.
Thank you so much for having me.
Absolutely. Everyone, coming up, housing affordability is one of the many issues on the ballot this November. A closer look at where the candidates stand next on Wealth. Just a month until the presidential election. There are a few key issues that voters care about, including housing costs. A new Redfin survey shows which candidate renters are favoring when it comes to housing affordability. Yahoo Finance's Danny Romero, she's got the breakdown for us. Hey, Danny.
Brad, the clock is ticking. We're getting closer to Election Day, and some voters already know which candidate they're favoring the most. A new Redfin survey shows that nearly half of renters think Kamala Harris would be the best candidate to tackle housing affordability, while 1/3 of voters think Donald Trump would be the best at handling the issue. And about 1 in every 5 renters are unsure about who would be the best candidate at handling housing affordability. Redfin economists say that renters tend to skew Democratic because a lot of them are young and live in metropolitan cities where the cost of living and housing is high, and people are more likely to rely on government for help. Remember, the president has tools to combat housing affordability, but they can't fix it all on their own. There needs to be a joint effort from the federal and local governments to incentivize more policies to fuel more home building. Separately, the influx of apartment supply is starting to fill up. Redfin found that more than half of newly built apartments finished in the first quarter have already been rented out within 3 months. And the uptick in demand may be a sign that building owners are attracting renters with more affordable rents and incentives. And it's important to know that the absorption rate for new apartments has been slower due to the influx of supply that has been added to the market. So that means renters have more options and the ability to negotiate. Brad?
All right, Danny, thanks so much. Appreciate the breakdown. As always, great reporting. We are just about 1 month out from the general election day, and many Americans are concerned about what the outcome will mean for their finances. Here with me now, we've got Kevin Keller, who is the CFP Board CEO. Kevin, great to speak with you once again.
Good to be back with you. Thank you.
Absolutely. Let's dive into this. You know, as we are just a month away here, and I mean, time is ticking here, but some of the biggest issues that you are seeing among those who are either represented by certified financial planners or those that are just trying to get a better handle on their finances, what are they thinking about going into this election?
You know, Brad, we did research a random sample of U.S. adults. So these results are kind of a cross-section geographically, demographically across the board. There's a lot of anxiety about the election. People are concerned about inflation. They're concerned about many still think we're in a recession, despite the fact that we've had 4 years of economic expansion, job growth kind of things. So, there's a lot. I think the way I would sum it up, the results of the survey is anxiety.
Interesting. And it's perhaps not surprising that nearly 80% of Americans are bracing for a financial fallout if their preferred candidate does not win, because that's essentially saying, okay, yeah, things are going to get worse if my candidate doesn't win. I mean, that's somewhat expected, but what is unexpected? Where are you seeing a little bit of overlap, regardless of where somebody's party or political alignment is?
I think one of the interesting, and it's been a trend over the years. It used to be the presidential outlook would be based on how the economy was doing. So think of Reagan in 1980 coming out of the malaise, and Clinton out of George Bush. But then now people's view of the economy is based on who is in office and who. So when former President Trump was elected, Republicans went from thinking that the economy was bad to all of a sudden it was good. And then when Biden was elected, Democrats went from thinking the economy was bad. So we see that trend. And it's something that Fareed Zakaria talked about at our conference just on Monday morning, because, making that observation that people are so much more tribal now.
What do you think, and with that in mind, what do you think should be said day one, or, once we've kind of seen the dust settle after the election, from whoever that winning candidate is and their party, to make sure that they're not just speaking to their party, but unifying all Americans within the economic message?
Far be it from me to, give advice to the candidates on what they should say. Here's what I would tell you, though, is even with, as we know, you look at the long-term trend for the markets, it goes up and maybe down a little bit. The markets go up. And so I think the advice would be to the broad investing public, stay the course, right? Don't do anything drastic. And that's really one of the benefits of working with a financial advisor. I would say a certified financial planner is that they help you plan for the future, not just the investments, but also your kind of whole financial life. So like Brian said, have a plan earlier in the show. He said you should have a plan, right?
Yeah, exactly. Just lastly, while we have you here, as we were taking a look at some of the ways that people build equity, whether that's in the markets, as you were just talking about, or whether that is even within purchasing a home. We were looking through some of that Redfin data, and nearly half of renters think Vice President Harris would be best for the housing and making that more affordable. But we also know that people's housing purchase plans change based on who is in office. How does that impact people's ability to build equity in what is perhaps the largest investment that they will make in their lives, many people?
One of the things that we found was because of this anxiety coming up with the election and who's going to win, folks were deferring major decisions until after the election. So we see housing, people putting off buying cars, taking vacations. But as we look at this specifically on housing, Democrats in our survey were slightly more likely to consider buying a house at this point than Republicans. I think that was a little bit surprising. I think one of the most surprising things as we kind of wrap up is that this anxiety, 1 in 8 of our survey respondents said that they have sought out a financial planner or a financial advisor because of the anxiety. And that's not unexpected. I think the confidence that a person gets when they're working with somebody makes a big difference.
Kevin, always a pleasure to get some of your insights, add some calm into the conversation as well. Kevin Keller, who's the CFP Board CEO. Great to see you.
Great to be with you, Brad.
Absolutely.
Thank you.
Everyone, whether it's historically high rent, student loan payments, or the stress of impending election, there's a lot for folks to be stressed out about, but everybody relax. But don't make your money worries worse by trying to spend your way out of anxiety here. We're talking about a trend called doom spending. Joining me now to explain, we've got Yahoo Finance's Rochelle Okufo. All right, so as Aaron Rodgers once infamously said many, many years ago, RELAX, relax. Break down doom spending for us, Rochelle.
I mean, I know it's tough in these times, but doom spending is when we put our brain essentially on autopilot and we shop to make ourselves feel better. And this is typically when we're stressed, when we're anxious, or when we're bored. Some of the same things that we tend to do with stress eating as well. Now, we've got a snapshot of how consumers are feeling from September's Consumer Confidence Index. Now, that showed the biggest decline since August of 2021, and that was across all components the index measures. So current and future business and employment conditions, and for the next 6 months, job availability in the future, plus total family income in the next 6 months, and expected household income changes. But of course, that quick hit of dopamine that you get from doom spending, well, essentially that's a coping mechanism, and it's at the expense of our savings, our investments, and our retirement goals. And it really feels counterintuitive when you're supposed to be shoring up your finances if we think they're at risk, especially for Gen Z who are earning less but actually participating in this. In fact, Psychology Today likens it to jumping into a lake because you're worried about the rain and getting your clothes wet. But here's the good news. You can curb that urge, save your finances, and still find peace of mind. Just get off of that add to cart button there, Brad.
So how can folks deal with that urge to doom spend?
Well, honestly, the first tip is to get real about your budget. So I'm not talking about strict penny pinching like a New Year's resolution, but really set up a flexible budget that works with your life and actually builds in a little bit that can be set aside for that fun spending. NerdWallet data shows that 67% of people who follow a budget report less financial stress. You can also use tools like Mint or YNIB, which is You Need a Budget, to track everything as well. That way you'll know where your money's going, which means fewer surprises and fewer mindless purchases. So you'll get some control there. Second tip is to know your triggers. Do you get the Sunday scaries? Is it after a tough day at work? Is it sales popping up in your feed? Are you looking at what's happening on social media and comparing how other people are living. Some of these are some of the most common spending triggers, and recognizing them is key. Bankrate found that 42% of people doom spend because they're bored or anxious. A good tip is to replace that trigger with a stress-free buster like a walk or a hobby, something that doesn't cost you money but does relieve that stress, and of course your bank account will thank you. And my final tip, sleep on it. Impulse purchases, they feel good in the moment, but that 24-hour cooling off period can make all the difference. Research from Financial Diet says that waiting a day cuts down on impulse buying by 48%. So give yourself some time to decide if you actually need that gadget, that outfit, or that extra home decor item. Take a breath, organize your plan, and make those doom spending urges a thing of the past. That peace of mind is priceless, and so is keeping your financial health intact, Brad.
Rochelle, great breakdown there. All right, I will try to doom spend less. I appreciate it.
You're welcome.
Guys, coming up, a Georgia judge opens the door for student loan forgiveness. I'll talk to an expert about what that means for your money next.
Are you a passionate investing bull? Maybe you love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains.
We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Credit cards are one of the most expensive forms of debt, but you may not realize just how pricey they can be. During the Fed's rate hiking cycle, average credit card interest rates climbed from 16% to well over 21%. Now that the Fed has lowered rates, it's time to consider whether or not you should switch up your card strategy. Yahoo Finance senior writer Kendall Little joins us now and has all of the details here. Kendall, so break this down for us now that the Fed has begun their cutting cycle.
Yeah, so we know that the Fed cut rates by 50 basis points last month, but there are several different factors that go into your credit card APR. And so let's say your issuer actually did cut your interest rate by the same 0.5 percentage. If you're already paying 19%, 24%, even 29% on your credit card, that's just not going to make that big of a difference. So instead of thinking about how you might want to change your card strategy, focus on eliminating your credit card debt and then avoiding those high interest payments.
So what can you do ultimately to avoid high interest?
So the number one thing that you can do is pay down your credit card balances. You know, this means not spending more than you can afford to pay off when your balance is due, or if you already have debt, you know, think about how you can put some extra money toward that balance every month. And then even if you're only paying a little bit over your minimum payment, that's going to make a difference over the long run. Another thing you can do is use a tool like a 0% APR credit card. These have intro offers lasting from 12 to 21 months on both balance transfers, which is for existing debt that you may have, or on new purchases. And so if you can avoid debt for several, or if you can avoid interest charges for several months, that's going to help you get ahead of any payments that you might owe. And then finally, make sure that you're actually reading your credit card agreement, reading that fine print, and getting familiar with anything that you could do that might add to the interest that you owe. So things like cash advances, paying late, return payments, these can all increase your interest charges and increase the amount of interest that you owe even more than your regular credit card APR.
Kendall, thanks so much for taking the time here with us today.
Of course.
Appreciate it. Great breakdown. Everyone, switching gears here, some good news for student loan borrowers. A federal judge in Georgia declined to block Biden's second attempt at broader debt relief. Instead, the judge ordered the case to be transferred to a federal court in Missouri. This ruling, issued Wednesday by U.S. District Judge Randall Hall in Georgia, opens the door to having student loan debt discharged for over 20 million Americans. Joining us now on this, we've got Betsy Mayotte, who is the president and founder of the Institute of Student Loan Advisors. I mean, how big of a shift is this, Betsy?
Well, I'm certainly more cautiously optimistic than I was. We have to remember that the judge has just sort of moved this to a different court. So the fight's not over yet, but it is possible that some borrowers may see some relief sooner rather than later.
So essentially just kicking the can, as you mentioned, over to a different court. What are the anticipations there? I mean, especially as the original suit we know was brought by 7 Republican-led states and Georgia here. So could we see another suit filed to block Biden's plan?
I honestly, because of what's been happening over the last couple of years with these Republican states and these types of debt relief, I do expect they will probably try to file another suit. The question is whether they can show that they have standing, and if they can't, then this debt relief can go forward, and it may be able to go forward in the meantime.
I mean, this is something that if we were to see debt forgiveness could have a major economic impact as well for millions of borrowers who will really receive the student loan forgiveness. But For borrowers, should we be holding our breaths? Should they be holding their breaths for this loan forgiveness to ultimately come through?
Well, I think it's important to clarify that what this relief does for most borrowers, it's not going to forgive all their loans. The most borrowers that would benefit from this would be people who owe more now than when they first went into repayment. And what this debt relief would do is sort of bring them back to where they started. It wouldn't forgive the whole thing. There are some borrowers that who have been paying for decades that would get full relief, but most people that would get this benefit would just sort of see them be brought back to where they started, which is still a great thing.
Yeah, absolutely. So let's end with some general tips for students. What are different ways that they can consider to fund their education?
Well, I'm always a fan of starting at a lower price school or community college to get your first year or two's credits, and then transferring into the dream school. Working and maybe going part-time and taking a little bit longer to get your degree can also benefit you financially in the long run by lowering the amount of debt that you have. And finally, if you do have to take loans, really try to pay the interest that's accruing while you're in school.
Betsy, great advice. Betsy Mayotte of the Institute of Student Loan Advisors, president and founder. Thank you so much for taking the time.
Thanks.
Certainly. Everyone, let's do a final check of the markets here as we are nearing 12 noon Eastern time. The Dow, the S&P 500, both in negative territory, while the Nasdaq is clawing onto some gains right now. It's still holding on to that positive territory of about 0.2%. S&P 500, you're seeing that flat just barely to the downside. That's been kind of in hyper oscillation over the course of today's trading activity, waffling between gains and losses. And then you've got the Dow Jones Industrial Average right now down fractionally by a little more than 0.3%. Everyone, that's it for Wealth. I'm Brad Smith. Thank you so much for watching. Guess what? You can stay tuned. Market Domination with Madison Mills and Josh Schaefer coming up at 3 p.m. Eastern Time. You do not want to miss it.